Good morning. On behalf of SIRC, welcome to this another useful learning session. First of all, we would like to thank each one of you, despite your busy schedule, taking the time to learn something new. Appreciate your efforts. I would now request the speakers to come to the dais. Shall we stand up for the invocation song?
सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्विमानः निर्विमानः अदेव शुक्रं परब्रह्मा अस्मिन् लोकः सर्वे तदुन्नाद्यतीतश्च नाद्यतीतश्च एतद्वैता 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 एतद्वैता.
So today's topic is going to be on international taxation, the flavor of the day with a lot of foreign direct investments coming into India. International taxation is the flavor of the day. Let me introduce the speaker. Sathyamurthy has over a decade of experience in audit, direct taxation and international tax. He started his career with Deloitte and worked for the audit practice of the firm for 4 years. He is experienced in handling various audit and assurance engagements. Further, he is experienced in direct tax and international tax, both as part of the MNC's tax team and as a chartered accountant in practice. He is a partner, currently is a partner in the firm Mukesh, Manish and Kalpesh. He extensively works in income tax and transfer pricing compliances. He supports clients in assessments, litigations, including representation before the tax authorities. And he is also an expert in FEMA. Now I request CA Manoj to present a memento and a shawl to Mr. Sathyamurthy. Please. Sure. Now I request Mr. Sathyamurthy to start this session. Happy learning. Thank you.
Good morning, everyone. It is a pleasure for me to present before you on certain basic concepts of international taxation. It has given me an opportunity to go back to the basics and have a relook and relearn some of the concepts which I had to look into in my early years as a member of a tax team. When I was responsible for direction of tax for payments that were made to non-resident, filing Form 15CA, coordinating with chartered accountants to get the certification, etc. As we grow and as we learn a lot of things, going back and staying connected with the roots of basics are key concept. That's why I think SIRC has come up with the concept of back to basics series on income tax over the last 1 or 2 months or so. In that context, today I start this session to today's seminar. I start with a very basic concept. As further we go on today, there are advanced concepts coming up in the next sessions throughout the day. So the topic for the day has been section 195 and certain forms that have been mentioned in section 195. So before I jump into 195, why do we go to 195? Just to set the context. Section 4 is the charging section in the Income Tax Act, and Section 4 subsection 1 says that the total income earned during the previous year by a person is charged to income tax. Then if also 4, if you read it will say that the assessment of the tax payable happens during the assessment year. That be the case, then what happens? Then how does the advance tax and TDS comes up during the year itself, when the transactions are going on simultaneously, or when I am earning the income during the year itself? Then subsection 4 subsection 2 provides for payment of advance tax, and that tax can be deducted at source wherever a person is earning an income. Then when we navigate chapter 17 deals with recovery and collection of tax, and chapter 17b deals about the TDS provisions. It contains various sections from 192 to 206A. In that, one of the sections is section 195, which deals with any payments made to any income chargeable to tax in the hands of the non-resident. That's the role of section 195. So that's how we land up in section 195. So any person who is making a payment to a non-resident, if that payment leads to income chargeable to tax in his hands, then section 195 gets triggered. TDS will have to be with it. We'll get into the language of the section and try to analyze each limb and get into it on the whole. So first I will concentrate on section 195 subsection 1. I am just presenting section 195 subsection 1 for your refresh of your memory. So when you look at it, it has several limbs. One, it says that any person who is responsible for making payment to a non-resident has to be there first. Then the payee should be a non-resident or a foreign company. Then the payment made should be any interest other than certain interests that are specifically dealt with specific sections. Then the amount should be chargeable to tax in the hands of the non-resident. That be the case, when do I deduct tax? Tax is deductible at the time of credit in the books or payment, whichever is earlier, like most of other TDS sections also. What is the rate at which tax should be deducted? Tax should be deducted at rates and force. This is the summary of 195 subsection 1. So, what is the objective with which section 195.1 was introduced? It was beautifully brought out in a summary in a ruling of Authority of Advanced Ruling AAR. They said that the objective is that the best possible estimate of tax liability in the hands of non-resident is deducted at source in India itself, as it is difficult for the department to go and catch the non-residents as they will be situated worldwide. They will not be present in India. Tax department has a difficulty in recovery of tax. So the intent of the section is that tax should be deducted at source. Tax should be deducted at source even at the time of the payment, at the best estimate possible. That is the intent of section 195. We discuss these limbs of this important limbs of this section when the section gets triggered. So I will try to go through each of these limbs and try to see what are all the issues that comes up there, what are all the interpretations we need to keep in mind when we get into these aspects. First is any person responsible for. So when they say any person, who are all included in that? Generally, a lot of sections will say where a taxpayer is carrying on business, where a taxpayer is subject to tax audit. The director has a lot of qualifications. But when it comes to 195, the widest possible language has been used and it should be any person. So when they say any person, does it include even a non-resident? How practically this could be dealt with? When we say that the non-residents should have also have the obligation to deduct tax. That could be a transaction between two non-residents. Say, for example, sale of share of an Indian company. That could give rise to income chargeable to tax in India. Still, do they have to deduct tax? What about all the procedural aspects like deducting tax? If you have to deduct tax, first of all, you need to have a TAN. Then you should deduct tax. Then you have to file the TDS return. Whether all these administrative obligations are also cast on the non-residents. How practically feasible is it? We do see certain comments from the judiciary wherein they have told that it creates a lot of practical difficulty, etc. However, after 2012 Vodafone ruling, the section itself has been specifically amended, and they have tried to give an explanation below the section and say that it extends to all non-residents, irrespective of whether they have a place of business, etc., whether they have any presence in India, etc. So as the law stands as of date, it extends to all the persons. Again, the expression "the person responsible for paying" is explained in different scenarios in section 204. Again, in the context of section 195, the below cases seems relevant. If we look at where in a transaction, if at all there is a foreign exchange asset, if at all there is any income arising from a foreign exchange asset in the hands of a non-resident, then even a AD banker has been brought into the expression that a person is responsible for paying. In general, any payer is included. Where the payer is a company, the principal officer is also included in the definition. He also has a responsibility to ensure the compliance with section 195. Then, where the person responsible for paying is a non-resident, they have told that the non-resident can authorize a person in India to do the compliances. Any agent who has been considered as an agent of the non-resident person, he can also do the complaints. The non-resident can get the complaints done through him. That is one of in the last 3 years or so, this particular class was also included. In a way, this facilitates the complaints by the non-resident. If at all they have any person who can do this for them in India, they are allowed to do this on their behalf. You can keep the session interactive. You can also share your experiences. Then and there, you can stop me and please feel free to discuss then and there. Next limb of the section is that the payment should be made to a non-resident or a foreign company. When they say non-resident, they specifically say non-resident not being a company. So they try to identify other than all companies, then a foreign company. So when we say that, what about resident but not ordinary resident? Any payment made to them, whether they are covered under the ambit of section 195. So the scheme of section 6 provides how do we compute the residential status. First we determine whether somebody is a resident or non-resident, then we go on to classify. Once we have told somebody is a resident, then we try to classify them again into whether they are ordinary resident or not ordinary resident. But in general terms, a person who is not ordinary resident is considered to be resident, so for them section 195 should not apply. Having said that, section 2, subsection 30, it's for specified purposes, it includes not ordinary resident also within the ambit of non-resident. But however, that figures only in those specific scenarios, not in all cases. So, for the purpose of 195, payment made to not ordinary resident should not trigger section 194 compliances. Then what happens is, any company which is incorporated in India, which is a domestic company, is always a resident of India. Then if at all any foreign company has a place of effective management in India, say for example, two of the board of directors who take all the residents, they reside in India, they take all the residents from India, etc. In some scenarios like that, the poem is determined to be in India. That be the case, what happens? So when we say that the poem is in India, he is treated on par with the resident domestic company. So that be the case. How in that case, if poem of a foreign company is distributed in India, whether section 185 will apply to payments further to make to them. Because when we say that we will treat them on par with resident, are we going to say even for the purpose of TDS, I will treat them on par and I will try to deduct tax on, say, 184J, etc. If we, for example, of a technical fee or a professional fee. There was a CBDT notification 29/2018, which tried to clarify certain things in respect of a foreign company having a poem in India. There, when they have touched upon the aspect of tax reduction, and they have told as long as the companies follow them, treat them as a foreign company and direct tax under 195, that should be sufficient compliance. So even if a foreign company has a poem in India, treat them as a non-resident. Treat them as they take that they are foreign company, then and that they are within the ambit of section 185. Any questions?
Even if they have a poem, we have to direct them on 195.
195, yeah. Because they are foreign company. By definition, they are foreign company. The language is also that 185 covers foreign company. Specifically, they also clarified that in case of foreign company, TDS complaints can be done as to their foreign company. Practically, in case of third parties, we may not have a visibility as to where they have poem, etc. But in case of group companies, we definitely may have, and then this question may arise at that time. So I will move on to the next link. The most important limit in this section appears to be any sum chargeable to tax under the Act. They have specific exclusions given are that wherever the interest is already covered under one of the sections for which there are specific provisions available, like interest on ECB taken in foreign currency, etc., which are dealt with 194 LC and other related sections. Then, if it is already dealt with that section, that doesn't come under the ambit of 195. Then any payment made, any salaries do not come under this ambit. Basically, section 192, which provides TDs for salaries, covers both payments to non-residents and non-residents. If at all there has been any employee for the company who has been a non-resident during this, still TDs of provisions under section 192 applies, 195 does not apply over there. So when we say any sum chargeable to tax under that, again it necessitates me to go back to my basics and see what is the scope of total income in the hands of a non-resident. Just to recap these provisions which we would have learned long back. Any income received, deemed to be received in India, are chargeable to tax in the hands of non-resident. Any income accrues or arise in India, are deemed to accrue or arise in India, are also includable in the scope of total income of a non-resident. If at all the non-resident has any global income which they earn outside India, that is not in the scope of total income. So when I say what is deemed to accrue or arise in India, again we have a list of items which have been deemed to accrue or arise in India. If any payment arises through a business connection in India, which includes significant economic presence, SCP, which was also introduced within the last decade. Then any property, asset or source of income which is in India, or capital asset which is situated in India. If any income arises from these, that is deemed to accrue or arise in India. Any dividend paid by a foreign company, dividend paid by an Indian company, even if it is paid outside India, that is deemed to accrue or arise in India. Then any interest, royalty, FTS paid by government of India or any person who is a resident of India is deemed to accrue or arise in India. However, there is an exception that if the business operations are totally in foreign company, say for example an Indian company has a foreign branch and the service related to that foreign branch, then that doesn't come under the ambit. Similarly, if in case of a non-resident, if the business operations in India and this royalty or FTS relates to that, still that will be within the scope of interest, royalty, FTS, etc. All these income are deemed to accrue or arise in India, so it is under the ambit of income for non-resident of India, which means it constitutes some chargeable tax in India. So obligation to direct tax under section 195 will be applicable in this terms. So I'm just supposed to look into the section 5. Looking into section 5 to determine what is the scope of income chargeable tax in India in the hands of non-resident, is that sufficient? What happens is, as I told you, as we started our discussion with section 4, which is the charging section. Section 4 says the income tax shall be charged in accordance with and subject to the provisions of this Act. So, whatever provisions that have been enacted through the Income Tax Act, all these have an applicability in determining the charge of tax. So, one of the key sections in case of non-resident is Section 90. Section 90 empowers the central government to enter into DTAA and other agreements with foreign governments. Accordingly, central government has entered into foreign government primarily for avoidance of double tax. All over the world, the countries try to tax on two fronts. One, they try to tax the global income of the residents of the country, some citizens of the country also, some countries. Whereas they also try to tax some income on source basis. If the source of the income is in a country, then they try to tax it also. Say for example, there is take India as an example. There is an Indian resident. He earns income across the globe. India taxes his income earned all over the globe. Then there are non-residents for who the source of income is in India. For example, we discussed this dividend royalty, FTS, etc. The source emanates from India, so they try to charge the tax. So what happens? Same income is taxed in twice. One is the source country taxes it, one resident country taxes it. So to try to resolve the double taxation, Indian government has entered into double tax avoidance agreement, DTAA, which we generally call as, across the globe. So, Section 90 subsection 2 provides that wherever DTAA exists, the provisions of the DTAA or the provisions of Income Tax Act, whichever is beneficial to the assessee, shall be applicable to determine the taxability of a particular transaction. So, when I say any amount sum chargeable to the Act, I need to look at Income Tax Act as well, I need to look at the TD as well. Okay. So, are there any conditions somebody has to bear in mind when they say that they have to resort to treaty? Can I say, for example, somebody is a resident of US. Does it mean that it automatically entitles him to take the benefit of India-US treaty? The Act provides certain prerequisites. Say, importantly, Section 90 subsection 4 says that the non-resident has to obtain a tax residency certificate from the Income Tax Department of this state in which they are resident. TRC should be produced so that we can consider treaty benefits. So again, when we try to, when we say treaty benefits, there are a lot of, it can mean multiple forms. Say one, the scope of tax as per the Income Tax Act could be wide, whereas the scope of the income as per treaty could be lower. Say for example, an Indian company obtains some audit service from US, a firm in US. What happens? Under Indian Income Tax Act, it is FTS, so it will be chargeable to tax in the hands of non-resident. But if I want to look at India, US, say DTAA, the definition of FTS in DTAA is a bit different. They say it is a fee for FTS, fee for included services, the language used there. It is fee is to be considered as FTS only if it makes available any intangible, like say technical knowledge, information, know-how, etc. Know-how, drawing, design, etc. Only if the service makes available any of this, it should be considered as FTS and chargeable to tax under DTAA. If that does not make available any of these intangible aspects, then it is not chargeable to tax. That could be one benefit. Then the rate could be different. In Income Tax Act could give a higher rate, TT could give a lower rate. Then there may be most. Yeah. Yeah. So, Indian company is making a payment to the foreign company. So, we need to see whether this payment is chargeable to tax in India or not. So, US company has earned audit fee from India. Is this fee chargeable to tax in India or not? I need to look at both the provisions of the Act and the treaty. When I look at the Act, Section 917 defines fee for technical service. It says any technical, managerial or professional services are covered. So audit is a professional service, so it is chargeable to tax in India. Section 115A says tax rate is 20% on gross. This is the chargeability as per Income Tax Act. Next I will go to DTAA and test. When I go to DTAA and test, let me show you the DTAA also once. So they use the term fee for included services. They say if such, again, as like how it is there in Income Tax Act, they are also saying technical and consultancy services covered. But only if such services either are ancillary or subsidiary to any property in India, or it makes available any technical knowledge, experience, skill, know-how, process, etc. to the Indian recipient. So in case of audit service, it will not make available any experience, skill, know-how, etc. to the Indian recipient. That is why it will not fall under the scope of fee for technical service article, this fee for included service article. So it will form part under general business profits article. Assuming they do not have permanent establishment in India. This article will say that it is taxable, any business profit is taxable only in the country of residence. So the US firm is resident of US, so it is taxable only there. So it becomes not taxable in India if I apply DTAA. So under that it is taxable, under the DTAA it is not taxable. So whichever is beneficial to the assessee. Section 90 subsection 2 gives me a leeway to say whichever is beneficial can be considered. In this case I will say DTAA is beneficial to me, so I will go with DTAA. Say for example, instead of audit service, if it's a training, somebody is coming and giving me a training, then it may get covered under TT because it says if it makes available technical skills, know-how, etc. If it makes available some skills to you, then it becomes a FES, then it's taxable. But still, the rate of tax given here is 15% in DTAA, whereas in 115A it is 20%. Again, you can apply the beneficial provisions of DTAA and say I will take 15% instead of 20%.
These are just applicable to the Indian company current company for the director services, managerial services, that they have IT services and all. I don't know whether sir, am I audible, sir?
Yes.
In the company, they have director who is taking care of Indian operations also from US. So for this they are charging something. And for IT services from there to India, they are charging, and they have a format in which the management cost is recharged to India. So in that case, how we should approach?
So which is the country from which they come?
US.
US. Good. So US, now we need to test. When we get into DTA, first this section, this is clearly a managerial services. So it is under the ambit of technical FTS under Income Tax Act. 115A says they don't have a PE in India. Foreign company does not have a permanent establishment in India. So 115A applies. When 115A applies, tax rate is 20% on gross. This is Income Tax Act. Under DTAA, I will see under which class this falls. I will have to see whether in that manner I will see whether this fee for technically included services, whether it will fall under this. So generally this concept of make available is that once I do this service to you, can you do anything on your own from henceforth? Say for example, when I train you, or I give you a drawing or design and say you will be able to manufacture. In those cases, it makes available something to the recipient. In those cases, these are considered as to be fee for included services in US. But in your managerial case, it does not make available anything to the Indian counterpart. So they can say, so it will not fall into this. So, the moment I say that this Article 12 fee for technically included services does not apply, I need to see which other class in DTAA is applicable in this case.
Suppose salary charged by subsidiary, because some senior management is sitting in subsidiary, the parent is sitting in India. Salary cost is charged for the senior management who is sitting in US to the given parent company.
Yeah, that is also covered in this. So,
It's a salary cost.
but you are not paying salary to the director. You are only paying the technical for the management service that they are providing.
Correct.
Yeah, that's such a
So, make available.
yes, that will not make available. That's it. The question is always that will the other person be able to manage it on his own? Will he get an intangible benefit out of it? As long as the answer for this question is no, I will have a dependency on them every time. All the years I will have to depend on them, then the dependency still exists. Then it is likely that it does not make anything available.
Sir, what absolutely understand because you're indirectly transferring from India to US without being chargeable tax on operating transaction.
Yeah, that is the provisions of the treaty which Indian government has entered into. No? This is a well-established provision, with a position which even high courts have blessed this position. But only thing is that if at all it is taken up for TDS assessment, they may try to do a fact finding, and they may try. So it is better that we are well equipped to prove that it does not make anything available to us.
Really, what the certifying auditors are saying, certifying third of the saying you deduct 10% irrespective of.
In US, if you see 15% the rate is.
Yes.
Yeah, if at all you feel it is risky or there is any doubt, because you are not sure whether it makes available or not, if there is a dicey question, probably the approach could be that let Indian company deduct, let them file a return and claim a refund. Let the department pick for assessment, scrutinize. If at all the implication will be that they will deny the refund. They will not, apart from that, there will not be any other implication. No interest, no penalty, nothing. In doubtful cases, we may try this as a litigation approach. To play very safe, but generally this position is even the high courts have blessed it should be easily be able to defend this. Only thing is we should see which country, whether that country DTAA has a similar definition, because the definition of fee for technical service or fees changes from DTAA to DTAA. If you ask me whether France also gives a similar definition, no. The definition is similar to Income Tax Act, it doesn't give. Similarly, if you look at Korea, this definition is not there. So we will have to go into respective DTAA and see whether this is there. If it is there, we can take this question. It's a well settled thing, and yeah.
In one of the cases, they disputed royalty versus technical fees. Since agreement is not stated clearly, one has to pay royalty, you have to pay technical fees.
Yeah.
They disputed.
Generally, royalty is for use of an intangible asset. They give some know-how. They give me how do we manufacture. They give me that drawing, design, etc. I pay for it, and it will be usually on the sales that I make, certain percentage of the sales that I make, etc. But in case of FTS, there has to be a service element, separate service element, embedded to be it. And then again, if it is closely connected with the intangible that they gave, so for example, know-how or something. Even that service are covered under royalty. Only if it is not connected with that particular transaction, then it comes to us as FTS separately. Yeah. So we need to look at the DTAA provisions as well, and then see whichever is the beneficial to us can be taken. Now the question is that treaty entitlement that I am using the treaty, is it absolute? Are there no conditions? Just because when I say I am a resident of US, am I allowed to use the treaty? No, there are some conditions that have to be satisfied. The most important one is that the Indian Income Tax Act says the benefit given under 90 subsection 2 is subject to the getting a tax certificate from the Income Tax Department of the company in which the payee is resident, the vendor is resident basically. So that is must. But again, we face a lot of practical challenges, both SSC and CS who issue 15 CB. What happens is TRC is not available when I am making the payment. It may be available after 3 months. Or TRC for the relevant year is not available, for the one for last year is available. After the client, the vendor says that I made an application, he is giving me an acknowledgement that TRC will be received, but as of today I don't have TRC in my hand. Then in certain countries they don't have the practice of issuing TRC itself. Still they are yet to come to that stage. So what do we do in all these cases? This is a practical issue that everyone faces. So, from the perspective of the assessee, as long as they have TRC is a must, no doubt. But looking at things from practical perspective, if I assume they have last year's TRC, last year the company has been a resident of US, and this year they have also applied. We can rely on their tax residency, their certificate of incorporation, etc. And we'll say that we will subsequently receive this, and they may take a call if they would like to assume it is a very recurring transaction. They have ongoing relationship, etc. They can consider that. Particularly, the challenges happen is the TRC is for the period January to December. So when we make payment during January, the earliest TRC has expired, and the department takes some time to process and give it. Wherever we would like to, it is not a related party or something we would like to stick with, then we may say, please you get it. Till the time we will hold the payment, we will not account your invoice, we will not make payment to you, you give it, then we will account it. That's also a process. So often, practically what clients in common ask is, they deduct tax as per that. As per that, for FTs or royalties, 20% plus the charge assist. They deduct it. Then after 2 months, they give the TRC and they are asking whether they can get the balance back. This question comes up from the client often. We tell them, boss, we have already issued 15 CEB saying this is we don't have a TRC and it is charged into that. You also filed 15 CA stating the same. So, how are you going to go back now? TDS return, it's easy to correct the TDS return. The system allows you to make corrections to TDS return, so I can correct it. But what about 15 CA, 15 CB? Can I correct that? Because the penal provisions for furnishing incorrect information in the 15 CA for the assessee is 1 lakh per form. 1 lakh per form is the penalty. So indirectly, are we not getting into that exposure? If we say, can I refund the back after as I receive TRC subsequently? No. That question is always there. That exposure is always there. So generally, we don't recommend such cases. We tell then you wait, don't make the payment, don't account the invoice. Let them give the TRC, then you account the invoice and then make the payment. That's the generally advised route in such cases. Then, in addition to the provisions in Income Tax Act, there are treaty itself encompasses lot of provisions as a condition to be entitled to the treaty. In subsequent section, we will be talking about something called multilateral instruments, MLA. What they, just in one line, what they try to do is they try to amend lot of agreements simultaneously. Say, for example, India has, if I say India has entered into treaty with 200 countries, if I need to make some amendments in countries, I need to go back to all 200 countries, speak to them and resolve it. To avoid this, what they try to do is they try to set a template, and whichever the countries agree to the template, all those DTA gets modified to whatever they agree. That's how they try to make, just with one document, they try to make amendments in a lot of number of countries. That's what is the multilateral instruments concept. So when the MLA was introduced, the template had few important provisions. Like first, the preamble of in most of the cases, the preamble which the treaty used to say that this is for the purpose of avoidance of double taxation. If you look at it. This is India UAE treaty. Just for example, I will take it. So they say this is for avoidance of double taxation, etc. They used to say. Then they tried to amend the treaty saying, while we intend to avoid double taxation, we also intend to ensure that there is no double non-taxation or reduced taxation. When MLA was introduced, this particular clause was brought in preamble. Similarly, they introduced a concept called principal purpose tax. In next session, it will be touched upon in very detail. I am just touching upon it for this. So you need to see what is the principal purpose for which you are entering into the transaction, for which you are making the arrangement. If the principal purpose itself is only tax benefit, there is no substance to the transaction, then they said you cannot apply TDA for all that. Then they consider something called limitation of benefit. The benefit under the treaty can be granted only if some conditions are satisfied. Say for example, in capital gains they said you should have held the shares before at least for 12 months. Except like that, they said you should have a physical presence in the country, you should have had a proper office, you should have incurred expenditure, there should have been a real substance, etc. In various treaties, they try to incorporate some of these and said only if you satisfy these conditions you are entitled for the benefit. Otherwise, no treaty benefits. All these provisions were introduced in the treaty itself. Then apart from this MLA, originally itself there is a concept called beneficial ownership. Say for example in this article in DTAA that deals with this royalty, FTS, etc., dividend, capital gain, etc., it will say that the person who is receiving the payment should be the beneficial recipient of that income. Meaning they try to say that if you are just a pass-through where you don't have anything on your own. Say for example, I am sitting in US today and my parent or somebody with whom I have contractual obligation to pass on the income immediately to somebody else sitting somewhere else. If I have such obligation, then I am not the beneficial owner. I am only the theoretical owner or owner on paper, and he is the beneficial owner. They said the treaty provisions are not applicable for all those cases. It's applicable only where the recipient is a beneficial owner of this income. That's the concept of beneficial ownership. Treaty itself have all these conditions, so these conditions should be satisfied. TRC should be there. Only then treaty benefit can be taken by the foreign. Anyway, these aspects of the TTI provisions will be touched upon later in subsequent sections.
Sir, I have a few queries, can I ask?
Yeah, please.
Just curious to know the practical challenges.
Yeah.
The last two scenarios.
Yeah.
The last two scenarios, country of resident does not issue TRC.
Yeah.
And the last scenario, payments made in online portals or credit cards, no direct contact with the vendor.
Right.
So that is rampantly happening in this SaaS model of work. Everyone uses credit card to swipe the online payments.
Right.
Sometimes even associates does that. Sometimes we don't even realize that you have made an overseas payment.
Correct.
Only we see the credit card statement, there are some multiple payments made to these SaaS vendors globally actually.
Right.
What is your views on the last two practical challenges?
Yes, sir. One, where the country of residence itself does not issue TRC, there is always a concept in tax that you cannot force me to do something which is impossible. So, an assessee can always take an argument saying that I will still avail the treaty benefit as they do not genuinely do it. And the condition that is false on assessee is that, so what is the intent of TRC is that you should make sure that he is a real resident in the country, he is not somebody else. So you try to get the certificate of incorporation, you try to get their income tax returns, which they have filed stating that they are resident, etc. Through other documentation, you try to prove that you are the resident of the countries, and they can argue, saying by to impossibility of performance, I can't force to do it and try to go on another treaty.
So TRC, so we can prove it not even though the country doesn't issue TRC, by an equivalent of a tax return or incorporation document, we can use it to prove the tax residency.
Yeah, we can argue on that basis. I believe that it's a good argument. If the country doesn't really issue TRC.
And credit card payments, that we made.
The credit card payments, see, there are no. What happens is in general, other payments made through bank, the banker requests for 15 CA, 15 CB, so there's a checks and balance in the system, which is why it keeps happening. In case of credit card payment, the check and balance is missing. That's the practical issue that we are facing. There are any specific relaxation for payments made through credit card. Only this rule 37 BB, which says that you need to file 15 CA, 15 CB, that they have given a list of transactions for which 15 CB, 15 CA is not required. For example, they say if it is import goods, if it is freight in relation to import of goods, if it is a ODA investment, which is anyway scrutinized by RBI thoroughly, etc., you are not required to file. Only in those cases you have an exemption. But where it is to credit card, there is no specific exemption. So all the compliances that are regularly applicable are applicable even to those payments.
Even though they make through credit card, though there is no formal channel they don't seek a 15 CACB to make a payment.
Correct.
But still they have to comply with this provision.
Correct. Yeah. So wherever we have some SaaS claims, what we have advised is, we have told them to contact their customer support, try to get somebody and try to get the TRC. So once they have the TRC, most of these payments are in the nature of software subscription. That happens to credit card. So recently it is well settled that software payments are not covered under royalty definition as per the DTAA. assuming DTAA language supports that. Most of the DTAA language supports that. They say copyright, any use of copyright is taxed as royalty, but use of software is just a copyrighted article. It's not a copyright by itself. Meaning when I purchase a software, I cannot license it again. I cannot sell it again. The license agreement will put a restriction that you can only use it. You can't do anything else on it, etc. So it is not considered to be royalty under DTAA. So it goes to business profits article. As long as they don't have a PE, permanent establishment in India, it's not taxable in India. So we advise them, you try to get into the customer support or somebody and then try to get the TRC. Once you have the form TRC, then you make the payment. When are you making the payment? You just keep informed so that they will file a 15CB, 15CA local. That's all.
So you mean say not just TRC documents? So in credit card payments also you are saying 15CB?
Yeah.
Or at least we can keep the TRC as a backup option, just in case.
No, TRC should be obtained. 15CB, 15CB should also be filed on the date of payment itself. Only thing is, in other cases, bank will ask this nobody will ask, but still the rule requires, so we do it and keep it. So far, nobody has come and asked why it is not filed, so people take it easily. But as I told you, for one single miss, the penalty given is 1 lakh per form. So better wait till they can assist, so let them file.
When is the need for Form 10F arises?
I have it anyway. I will touch upon it. We have told it. Form 10. So this for. Next to 90 subsection 4, there is a 90 subsection 5, which gives this idea of Form 10F. They say that whenever your TRC issue does not contain these 5 information, status, any of these 5 information, like status, whether it's an individual, firm, company, information like that. If he is a resident, if he is an individual, what is the nationality of the individual, or if it is a company where it is incorporated. Then the tax identification number of the country in which they are a resident, then the period to which this TRC relates to, then the address of the. If the TRC has all these 5, Form 10F is not required. When TRC does not contain one of these 5 or all these 5, then Form 10F has to be filed. All these days, till a year back or so, this Form 10F was just, the CBDT has prescribed the format. We used to take a print, fill it up, get it signed, and then keep it in our records. Recently, a year back or so, what they said is, they listed this form in one of those forms which are required to be electronically filed and to be verified through digital signature. So now what has happened is, if I have to file this in income tax portal, I need to have a PAN, because without PAN I can't log in into income tax portal. So I need a PAN, then I have to log in, then I need to have a digital signature to sign it. So lot of practical challenges on the front of non-resident has happened due to this.
So in case where TRC is not there, then filing of form.
No, TRC is not there, no issue. TRC is there. TRC does not have any of these 5 information, the status, nationality, etc.
Right, sir, if the TRC itself is not there.
TRC itself is not there, treaty benefit, no treaty benefit.
Some countries, the TRC is not in English, in their own local languages actually. That's, in those things we should insist upon a translation actually.
We can get the translation, or at least we can get it so that we can get it translated later if required.
But it's not mandatory, right?
Not mandatory as such. And what I have seen my guys doing is they try to put it in the Google translation to see whether the name is matching, etc., and then they accept.
Assuming conservatively take a stand, though treaty says not a direct TDS and the domestic company takes a stand direct TDS, and just because the Indian entity took a stand to direct TDS, does it create an obligation on the part of the foreign entity to file returns in India?
No, what happens is, this section for filing tax return in India, see, any person who earns an income in India has to file a return in India. So even foreign companies who earn income from India, they are required to file generally. But one relaxation that has been given is that if the income is only in the nature of royalty, FTS, dividend interest, and tax is deducted at rate prescribed in Income Tax Act, then they are not required to file a relaxation has been given. But now that 115A, they have told the rate is 20%, invariably, in lot many cases we try to resort to treaty for lower rate, then the obligation to file tax comes. Because the condition that the tax rate as per Income Tax Act is not satisfied. they are obligated to pay return in India.
So if someone has followed a treaty benefit to direct TDS,
Yeah.
Then automatically the foreign vendor is forced to file returns in India.
Right, yes.
Thank you.
Yeah, as I told you in the context of whether TD's directing obligation can be forced on a non-resident, then at that time Supreme Court even used to give an observation saying, asking the person who is totally outside India to follow all this are difficult, etc. But anyway, there is no clear conclusion that it is ultra vires or it can't be done, etc. And often what happens is they have some counterpart in India, some subsidy or somebody in India, and then they have told that a person in India can be appointed as agent to do the complaints. So I think it's order of the day that they have to do something.
But when they don't have PAN number itself, how do you
Sir, what recently I saw, I read an article where Income Tax Department they have suo moto allotted a PAN and then they have sent a notice to a foreign company. Just for sending the notice to a foreign company, they have suo moto they allotted a PAN and then sent the notice. Because their ITBA portal does not allow issuance of notice without a PAN. They got the details from the TDS return filed by the Indian entity and the amount was large, PAN was not available. So they started doing this, but I read an article, although I don't know, personally I am not connected to this. Legally they are obligated. There are definitely practical challenges in catching them if they don't have a PAN. And that's there. Maybe in days to come, in years to come, they may be able to trace the Indian counterpart, they may try to treat them as agent, etc. Possible. But anyway, if the tax liability has already been settled by way of TDS, then they may not worry much. Only when the tax rate is not appropriate or etc., then it becomes a pinch point for income tax. Yeah. So as I touched upon, the spontaneous people who are required to have a PAN in India are required to use the route of getting a PAN and then filing it through the portal. They have told we will also give a facility to those who are not required to have a PAN and who don't have a PAN, they don't have to do logging in. They can file it without logging in and using a mobile OTP authentication. A lot of people who are also required to file the return because they have DTAA benefits also try to take benefit of this route and file 10F and give. So a lot of data come whether this is valid, can we accept. Nowhere in the rule or law says that only you have to do through PAN with login. So as a director, at least can I accept this? No answer, no. But both ways keep happening. Something is better than nothing. At least get that form 10F and place it on records. Sometime we
filed in India or
10F, sir. 10F is to be filed in India, sir.
they are making payment, we have to file 10F for that, right?
No. They have to file 10F. They have to file 10F and share with us for directing tax. If the TRC does not have all the file information. Then again, so one more when we talk about the sum chargeable to tax under the Act, few other challenges comes up is in case of royalty, fees, interest, etc., where the taxation itself is on gross amount, it becomes easier. But what if the amount is not that way? Say for example, capital gain. In capital gain, what is chargeable to tax is only the net capital gain after deducting the cost of acquisition from the sale consideration. In that case, how do I deduct? I have information only about his sale consideration. I don't know what is his cost, how he will compute his capital gains, etc. What happens in that case? Yeah. There is a facility to apply, make an application to the income tax officer determining the tax rate. You can get it done. So again, there is even a Supreme Court precedence which says that as long as you don't get a certificate, then you can withdraw the gross. There is no ultra vires act on our part to determine that only some portion is taxable and try to deduct on the net amount. However, having said that, the concept that what is chargeable to tax is only the net amount, where the Act specifically shows as a concept that is still there. So a question came up as to where the assessee did not deduct tax, they have to pay interest for the default period. So on what amount should I compute the interest? Or when I have to do a 41 disallowance, what is the amount I should disallow? Say for example, I pay 100 to a non-resident. He has expenses of 70 and what is chargeable to tax is only 30. Say for example, because this is not something chargeable on gross amount. Then on what amount should I disallow? Should I disallow only 30 which is chargeable to tax in a sense, or should I disallow entire 100? There also the circular beneficiary said that the assessing officer can determine what is chargeable and disallow only that, not the entire payment. That's what was. So as a concept, that what is chargeable, the amount is only the net amount is only chargeable to tax is there, but unless the department issues a certificate, we don't have any other suo motu channels through which I can determine that amount as to what is the amount chargeable to tax in the hands of non-residents. That has been a perennial challenge that has always been there. The simplest example I gave you is this capital gains. Apart from that, lot of large contracts happen when, say for example, somebody is setting up a factory. They try to import the materials from the vendor, and then the vendor comes here, and then he does the setup, installation, commissioning, and all that. And then the entire thing is a single contract. So this contract has 2-3 components. One, some goods which the ownership of which was transferred to me when it was in that country itself, or when it was in the ICs itself. Then some goods which the ownership of which I received only when it reached India. And then all these service elements. If you look at service elements, definitely not taxable. The element for which it is overseas, it's an overseas supply. Where I got the ownership there in the seas, that's not taxable, clear. The one in between, it may require careful evaluation of facts. But the consideration that they agreed is just a single consideration. Again, what do we do? All these cases, they say you go to department, but practically sometimes it takes even 6 months or so for getting the certificate, convincing him for an appropriate date and getting the certificate. Then what is the exchange rate to be used? They told TT buying rate published by SBA as on the date on which the tax is required to be paid. That is payment target whichever is earlier. Then time of deduction, payment target whichever is earlier, which account you create doesn't really matter as long as you are able to identify who is the recipient. All that concept which applies for all other sections applies even here. Then what is the rate which I should apply? They have told rates in force. Rates in force is defined. They have told whatever is given in the back of the Finance Act every year, it's to be done. Here I just like to touch upon one point where if I am a non-resident of the foreign company, if I don't have a permanent establishment in India, the royalty FTS is taxed on gross basis at 20% under the Income Tax Act. Assume I constitute a permanent establishment in India. See, permanent establishment in India can be constituted in many ways. Say I can have some small office kind of setup, or even some TTs have a concept called service fee. If I come to India and I render service for a continuous period, say for example for more than 90 days, then I constitute a service fee. Like I told you, a large installation projects and all, easily service fee gets constituted. If that be the case, the taxation mechanism in the hands of non-resident is that he has to compute the PGBP, and then he has to pay 40% on the foreign company. In case of foreign company, applicable tax rate is 40%. He will compute 40% on the net PGBP amount. Again, as a detector, what do I do? Intentionally or unintentionally, conveniently, the part 2 to chapter 2 of Finance Act, which gives this rates in force details, they don't say whether there's a PE or not or not. They just say if it is royalty or FTS, 20%, that's all. They don't ask, at least the payer is not technically not required to be worried about whether it is PE or not, as long as the nature is the royalty or FTS. So, in case that the payer has his own doubts because he has crossed that 90 days or he is about to cross the 90 days, etc., I recommend you don't go for TT benefit. If you go for TT benefit is only if you don't have PE in India. So if you believe you may have PE in India, at least when you withhold at tax rate, let him file a refund, file a return, and then now it is paid, let him take that. So that at least there is no non-complaints on the part of the Indian payer. Particularly in case of third parties, he would not want to take this. Then the TD amount can be recovered from him, interest, penalty, etc. So practically this particular route is taken in many cases where we have doubts on PE exposure of the recipient. And then to a couple of other points quickly I want to touch upon is this. This 206AA, earlier it was very relevant because 115AA rate was 10%, this was 20%. Now both are 20%, we don't really feel the impact of 206AA. Where they say if you don't have PAN direct tax at 20%. That's provision. Then one more thing that has been time and again clarified by the judiciary is that the rate in DTAA is final rate. You don't have to add surcharge assess on those. Unlike income tax rate where you have to add it separately, applicable surcharge assess. That's one point we should remember. Yeah. Okay. This is 185. 195. One is the most important section. These are the mechanics that we discussed. Then few other subsections of the same section, 195.2, 195.3 and 197. As we discussed, all these are about making wherever we are not very sure as to what is the sum chargeable to tax. Then you make an application where the payer, the person who is responsible for payment, if he is making an application, he will make under 195.2. If the recipient is making an application, they are furnishing the certificate to you, then they will make under the other two sections. All these are procedural aspects. I will not touch upon in the interest of time. I will simply this. Again, when it comes to filing of Form 15CA, 15CB, when it is required, when it is not required. I will just try to summarize that in this flow chart. If we say that the income is not even chargeable to tax in India, then no 15CB, 15CA Part D, nothing else to be done. Or if that is specified under a specific exemption list given in the rule, as we discussed, personal payments, ODA, import, related freight, a lot of things have been listed. That be the case, you are not required to do it. Otherwise exempt, anything otherwise exempt will be only Part D. Then if the payment is chargeable to tax but total payment does not exceed 5 lakh in a year, Part A of 15CB, Part A of 15CA, that's all, nothing else. Then Part B is if you have obtained a certificate from the AO as to what should be the rate, which should be, what should be, then Part B should be done. In case the case is not covered under any of the three, then you have to get a 15CB certificate from a CA. Then based on that you file Form 15CA Part C and go ahead about it. That's the crux of this entire provision. Again, I think in the interest of time, I have some few case studies which I will try to discuss quickly, which could be have a practical influence also. In one, there is a tenant who pays rent. That house owner is a non-resident. Whether TDS provision is applicable, whether Form 15CA, 15CB provision is applicable. He is just individual, he does not do any business, nothing. He just pays a rent, but the flat is owned by a non-resident. He saw any person covers any person, so he has to pay, he has to deduct tax, he has to pay Form 15CA, 15CB, he has to pay 27Q, he has to issue TDS certificate, everything applies. Similar example again, individual not carrying on business, he is purchasing a property from a non-resident. Again, all compliances apply. Only catch here is that there at least you will know what is the amount taxable, what is the rate applicable if he is individual, etc. Here you will not know what is the capital gains. So technically the tax is only on chargeable tax, but you may have to go to income tax authorities. I shared the language of the Supreme Court also, which said that if you don't know, better you get it from the department or do it on the cross.
But if the tenant pays NRI who are engaged in India, this or not.
No, if he is a non-resident, whether he has PAN or not doesn't matter. As long as he is a non-resident.
No, he is talking about NRI having an NRI account, and I am depositing in rupees. Then what happens?
Even then it applies because he is a non-resident. To which amount you pay doesn't really matter. There are no provisions which explains it. There is no exemption given. If you pay to NRO account, you are exempt. There is no specific exemption.
It's a lot of problem for people who are having plans in India.
Agreed, sir. 100% I agree with you, but that's how the law says. Lot of people are not aware. Even my brother purchased a property from a non-resident, then I told him you have to do all this. Nobody knows this.
But departments are sending notices to people saying that you have made the rent payment to an NRI, so you have to deduct tax.
Yeah. Nowadays they have started sending. Yes.
Thus they exclude the NRI files, they have PAN in India.
Nothing to do with PAN.
As a PAN they may not exclude, sir, because everybody will get PAN then. They, at least NRO account, they can think whether they can do it at that point of time, and then they can say, if he transfers to NRE or if he replaces at that point, he has to pay. Some mechanism can be brought from. As of today, nothing. The obligation is still there.
Even if the amount is credited to NRO, 15 CA CP is credited.
So if it is just a transfer from one bank to other bank account, technically.
Talking about rent payment. He's talking about rent payment to an NRI.
Yeah.
15 CA is.
15 CP, 15 CA is equal.
Just filing on 27Q does not satisfy the requirement.
That 5 lakh limit per year we should see. 5 lakh limit is less than 5 lakh, then part A of 15 CA, otherwise 15 CB and part C of 15 CA.
Sir, in some cases in property transactions, we are not even aware that the seller is an NRI.
Okay, agree, sir. Agree. Practically happens.
How do we figure out and then apply?
We have to ask him, sir. We have to ask him. We have to get some declaration, etc. from him. Yes, sir. We discussed a while back also. Generally, a person who is earning income in India is required to file return. Exception is given only if it is interest, dividend, royalty, FTS, and tax is deducted by the return at the rate specified in the Income Tax Act. Then exemption is available. If DTAA rates taxes deducted at DTAA rates, or there is some income for which you have a lower rate is deducted, then you will have to file the return.
Suppose it is not filed return, then what is it?
Sorry, sir?
Suppose if they are reading the TDS,
Yeah.
they are giving certificate to them also, Form 18 CFCP also given to them. But if they are not paying, they are not filed return, any impact is there for the directly.
Department may send them a notice and ask them to file a return. They may do that.
But you are not responsible who will be.
He is responsible. As per Income Tax Act, he is responsible.
But he doesn't have any PAN number.
He does not have PAN number, you were saying. Then the process of finding him and sending him for the department is difficult. But I heard they have started doing even that.
The question is here, the department is issuing the notice to the directly.
They do that also. They do. But see, directly, as long as directly has complied with all his responsibilities, you can't ask him why he has not filed the return. Technically, unless you treat him as agent of him under 163. You have a close connection, that is true, and if they try to treat them as agent, then that's a different matter.
But any extra burden is there for directors?
Any?
Extra burden is there for directors?
No, see.
Filed return by the director.
No, nothing. As long as he is non-resident, nothing. At least in case of residents, that non-filers, they have rated that higher rate for non-filers. They have not filed return for 2 years. You have to rate higher rate. The 206A provision that they have recently introduced, but that is not applicable to non-residents. So this should not be in a problem. So again, next example is that one non-resident is selling shares of an Indian company to the other non-resident.
When buying a property from NRI, tax has been directed under section 195 and 27 has been paid. When the payment is made to the NRI, whether we have to file from 50CA, 50C.
Yeah, we have to pay it.
But the bank only pays it. Suppose if the purchaser goes to a bank loan, the bank pays the NRI. To the NRO, not.
That's why. Whether the payment is made to NRO or NRE doesn't really matter. If the obligation to pay, as long as you are paying to a non-resident, the complaints is service applicable.
Bank should insist on the
Generally, when it is in foreign currency, they definitely insist. If it is an INR, sometimes they don't. They miss out from their NRO.
They know that they are doing it only to the NRO.
NRO account, correct. Ideally, they should not miss it, correct. Agree.
They are not insisting. Probably come to us or.
No, you see, the obligation to file is with us. Yes.
case rent, what is the TDS rate? Rent or
Sir?
TDS rate for rent?
Yeah, TDS is applicable now, sir.
Rent payment to non-resident.
Non-resident, yes, TDS is applicable. TC, ERCB will be applicable based on the threshold.
Normal rate 194 I
No, he is non-resident. No, the owner is a non-resident. Only when the owner is a resident, 194A applies. Or there is 194M or some other section is also there.
No,
When the owner is a non-resident, 195 applies.
195, what is the rate?
Rate you need to see what is the rate applicable for him. Say if you individually you say it will be maximum margin rate applicable to him will be 30% plus surcharge. Then next example is one variation is that one non-resident is selling a company shares of an Indian company to another non-resident. Chargeable to tax in India? Yes. Where all compliance is applicable? Yes. Then one non-resident sells shares of a foreign company to another non-resident. That foreign company owns substantial assets in India. That is also covered, and nowadays that's also covered under the ambit of indirect transfer. Chargeable to tax in India, then yes. And then we have a group where the Indian company subsidiary is there, US holding is there. US holding company is issuing ESOP to the employees of Indian company. Are there any TDS implications here? So when you pay to the employee, 192 applies. Where 192 applies, no 195. Suppose the Indian company pays something to US company, then we should see whether it is chargeable to tax. If yes, then you will pay tax. This happens every time. There is some expenditure of the Indian company has been paid by the foreign company. Say those, so they make a reimbursement to the foreign company.
195
But it is just a reimbursement, sir.
Any payment to them.
But any sum chargeable to tax in India. Is the reimbursement of expenditure is income chargeable to tax in India?
Any payment in India.
I agree, sir. Any payment is fine, but any payment chargeable to tax in India, no?
Any payment.
Any sum chargeable to tax under that. So, for reimbursement, is reimbursement of expenditure is chargeable to tax in India in the hands of foreign company.
This will be one tool for transferring all the money from India to reimbursement.
So the question here is what do we understand by reimbursement? I put somewhere this. Yeah. What do we understand by reimbursement? It's something very important. So when I say something is reimbursement, there should not be a service element between one party to other party. There should not be any profit element in the transaction. Then the obligation to incur that expenditure should be that of the other person. Just for administrative convenience, I incurred it, and then I am getting reimbursement. Say for example, the holding company's auditor who is auditing the consolidated accounts, he went to the subsidiary, he went to the other foreign country and audited the subsidiary. He incurred some hotel charges, taxi charges. Foreign company for the time being paid it. Then they are claiming from India company saying, it's your auditor, your consolidation audit expenses it is. Is it not a pure expenditure? It's a pure reimbursement, right? He paid to this. Ideally, a holding company's auditor, his expense should be borne by the holding company. Subsidy paid because the auditor is there in the country for that moment. Say L&T's auditor is sitting in India. L&T has a project in Oman. The auditor from India visited Oman. He just paid some stay expenditure and this expenditure. The Oman company paid it. They are asking the Indian company to reimburse it. Indian company reimburse it. If you look at this transaction, all these conditions will be satisfied. There is no service rendered by the Oman subsidiary to the Indian holding. Then there is no profit element in the transaction. Whatever cost he actually paid, he is just getting it. Who had to incur this obligation? Obligation as Indian company because it is the auditors of the Indian company who is going there, not the auditors of the subsidiary. Then just for administrative convenience, for the paying the total wala, Indian company cannot make a net for a foreign currency remittance, so they paid it. That's why you say it's a pure reimbursement. There is no income.
In this case, we are other party who paid, they raise an invoice on me.
Right.
Okay, without any supporting.
No, supporting has to be there. Why supporting has to be there is supporting will prove that there is no profit element. I am charging cost to cost.
If there is no supporting, they say there is no supporting, then I will attract 195 and then.
Yeah, right. If there is no supporting, then it becomes difficult to substantiate its reimbursement. So we.
So they specifically mention reimbursement of expenses.
Agree. They should be substantiated because all this, the chances that all this will be scrutinized is much more.
Sir, can we extend this point to if we pre-incorporation expenditure of subsidiary company, the holding company is sent it, can we do this without that? Can we consider that as a reimbursement?
Yes, sir. Yes, we can.
Whether there is any specific purpose for the reimbursement and we are treating that topic to the client.
There will be something called income not in the nature of income. Other income / income not in the nature of income. Like the code will be there. I'm not remembering the code, but some option will be there.
Choose that not, if you are filing Form 27Q based on that, then notice comes saying that you have charged 40%.
No, one thing is that if something is not even income chargeable to tax, I will not even take this in 27. I will file a Form 15CA Part D and say this is not in the nature of income, and then I will leave it there. But often what happens is people try to say, I make a reimbursement of salary to the holding company. Generally, salary and all cannot never be a reimbursement. What does it mean? That means that employee has rendered a service to you. That is a service element. Once there is a service element, then that cannot be considered reimbursement. So we should be careful to see if it satisfies the pure reimbursement. In this case, we may argue that it is not chargeable to tax in India, so no complaints.
Situation where a foreign company, a big company having a branches all over the world. So this foreign company is having a particular software service from an abroad. So this software is installed in every subsidiary all over the world. So the software company issues one field to the parent company. So the parent company appropriate and push down this expense to their respective subsidiaries. So parent company will take the money from the subsidiary as well. So will this cover under reimbursement?
Yes, sir. You just need to prove that all the 4 conditions are satisfied. That they don't add any markup at their end.
Okay.
The identification of cost, what is attributed to, is correct. Like, say for example, with number of users or etc.
Okay.
Once you maintain all this, then you can.
So the appropriation, the way the parent company appropriate this expense, so we need to have a proper documentation of that as well.
Yeah, correct.
Thank you.
That's what. As I told you, if somebody says reimbursement of salary, then I would tend to see that there should be some service element and it's a red flag to consider something as a reimbursement. Next example, yeah, this happens. So, software licenses. When I make payment for software licenses, what happens? Royalty definition as per Indian Income Tax Act includes software license. Most of the DTAA excludes that from software definition, which is well settled by Supreme Court also now. But again, if you are having treaty benefits, the TRC, TNF, all the conditions should be satisfied. Even if you are making payment through credit card, as we discussed some time back, no relaxation from conditions, all conditions should be satisfied. Then we discussed about the concept of making available. I make a payment to a service which does not make available anything. So what is the tax implication? What is the complaint subject? We discussed in some of the examples. Under DTAA, it is not chargeable to tax. So should I file 15CA or 15CB or not? That's the question that comes up again. Because in 15CB slide we told if it is an income is not chargeable, then you file just to part 15C, part D. If it is not chargeable, we said that. So does this apply for this? Answer is no. Taxable as when it is not taxable as per Income Tax Act, then that argument is correct. If something is taxable as per Income Tax Act, only not taxable as per ICAI, then it has to be either part B or part A or part C. You will have to see 5 lakh limit exceeded, part C, otherwise part A. And if part C, 15CB will also go. That is something we wanted to touch upon. Then okay, one more interesting point. in this DTAA, we discussed about making fee for professional service, fee for technical service to US. Similarly, assume in a scenario I am making a payment to UAE, a company in UAE. Interestingly, what happens is UAE treaty, it has a class for royalty, then it has only for capital gains. There is no specific class for fee for technical services. What happens then? How do we apply the treaty provisions? We have till tribunal rulings which rule that you evaluate whether the payment will fall under business profits or other income, depending on what is the business of the assessee. Then you apply that profit, those articles. If you say it is business profit, then it will say if there is no PE in India, no tax. Other income, then read the article and apply it. Just because a particular class is absent does not mean that you can't apply treaty itself. That's not the interpretation. Then you see under which other class it fits in, then apply the particular class. That's the thing that is. Then this also we discussed. When I don't get any documents, what do I do? I'm not sure whether they have a PE in India or not, etc. Then, as I discussed in this table, you try to go based on Act and say take 20%, so that at least as a payer you will not have any obligation. It's for the payee. Even if he has PE issues, it's for him to sort it out. That's the point. If you have any questions, happy to answer. Sir? No, here, what we, in the last example that I took is,
he makes reimbursement of salary.
Reimbursement of salary, yeah? That's what, salary expense, it's very difficult to argue that salary is a reimbursement. The moment I say, what are we trying to say, the transaction is that, a person from my holding company came to India, he was here for 1 month, for example. This Indian subsidy is making a reimbursement of the salaries which he would have got, which the holding would have paid to him. So technically in this transaction there is a service element which was rendered by that holding's employee to the subsidiary. So where there is a service element, you can't say it's a reimbursement. Say for example, I am rendering some service to you, I can't say I am getting reimbursement of the stipend that I paid to my article. That's the obligation to pay it is on me, and then there is a service element in our transaction. Similar, when the holding's employee is rendering service to the subsidiary, actually there is a service element from holding to subsidiary, and the obligation to pay salary was with the holding. So terminate a reimbursement is not correct. So it should be considered as a service fee, and then you should treat it accordingly.
It's a common resource sitting there.
But how do you say it's a common resource? Are you an employee then?
He's employed in holding.
He's employed by holding, so he's his employee. Then this takes this looks like taking a color of a transaction of a holding and rendering service to employee. But there are a lot of variations in the small tax changes, the answer tend to change and fluctuate, but the safest stand is that there is a service by holding to subsidiary. You test whether it makes available, is there a make available class, can we take benefit of it, all that we can test. Yes.
Holding company having multiple subsidiary company across the country.
Yeah.
So they are raising a bill to each subsidiary company as a business promotion cost. This level of they are developing the entity in different countries. So they are having some basis. So how do we make the remittance? Is it a business profit or how to transfer how the remittance will go from Indian subsidiary?
So here the question is, what does the Indian subsidy get out of this?
They are promoting business in India by establishing an entity in India. They are establishing one more subsidy in India. Like they are establishing multiple subsidy in different countries. What if they are the holding company in Germany? They are incurring say 1 lakh euro or something. They are apportioning among the subsidies. But they are not giving any document or something, but they are asking for the remittance for this particular invoice. They say around 20,000 euro or something. What is Indian subsidy?
So what exactly the team sitting there is performing, we need to get into details to see whether it will fall under fee for technical service or not. If you say it is something technical managerial or professional, then it will take the color of 50s, then we will have to see TT, etc. If we say no, it's a very administrative aspect only, then it may not fall under that. Then it need not be necessarily chargeable to tax. But only thing is, when you say somebody sitting outside is trying to promote my business and all, you should not creating a PE of this company in that country.
No, actually, they are establishing a subsidiary in India. Like that, many.
Understood.
This management team sitting abroad and they are doing identifying the evaluating.
So when you say they are management team, then the chances that the services are managed in nature is more. Then it is me.
So in this case, what document we should get to make the remittance?
We should get the complete detail right upon what exactly they are performing. If you are satisfied that it is FTS, then you treat it as FTS, direct tax and close it up. Or if your treaty says it is not chargeable tax because make available, you take the print. So when you consider it to be a business profit and say it's not taxable, now the onus is on you to prove that it is not FTS. So what all do you need for that? You should know the nature of service exactly they perform. You should rule out it's not technical, it's not managerial, it's not professional, etc. So to do that, you may need the exact agreement with the exact scope that they perform. Then some actual, say, mail exchange, presentation, whatever happened during the course of performing the service to prove what exactly they have done. So better collate all this in advance so that we will be able to address if any questions come up. Then, sir. Sure. Last question.
Mostly in case of a financial institution, they issue a debentures, mostly a listed debentures, and it was subscribed by a lot of debenture holders. Say it includes also a non-resident. Say for 1,500 customers. So when making the interest payment, how do you include that? How to pay how much is the non-resident? Separate. Generally,
so you are saying, as you are saying, it is a listed shares, listed debentures. The share is registered, say like this Carway, etc. They will have the details. They will generally collect the KYC documents every year from all the shareholders. We have that SEPSA, etc. Right, which maintains centrally this KYC document, and then they keep giving to all the things. Based on that, they keep updating the records. We rely on the records given by the share register.
On the 20%
no, generally what happens is all these listed entities, they roll out an email, say before end of giving 15 days time or say, so giving them time to submit the TRC form 10F, etc. If they give all the documents satisfactorily, they consider treaty benefits if that is beneficial. Otherwise, go beyond. That's the practice of being followed by all these entities. The discussion was two-way, was very helpful for me. It was very easy for me to present before you, and it was very enjoyable experience as well. Thank you very much again.
Thank you, Satya sir, for the very useful and engaging session. And also thank the audience. Okay, the questions were quite pertinent, and I hope Satya sir answered all the queries. We have a few more eminent speakers for the day.
Thank you all to this knowledge sharing session.
I'll check once again, but I should
I would like to welcome CAK Bharathi Krishnaprasad to occupy the dais. CA Bharathi Krishnaprasad is a chartered accountant and is presently associated with Lakshmi Kumaran and Sridharan since 2015. She has previously worked as a corporate banker with a leading private sector bank in India. Bharathi focuses on direct taxes and foreign exchange laws. She advises clients on a broad range of issues relating to domestic and international taxation. She also handles compliances and litigation up to the stage of tribunals. She is also a qualified company secretary and cost and works accountant. Besides, she has also completed all 3 levels of examinations conducted by CFA Institute USK. With this brief introduction, I welcome again CAK Bharathi Krishnaprasad to this knowledgeful session. I would like to request CA Adishri to present the memento and to adjourn this hall to the speaker.
Very good morning to all of you present here. It's always a great and a nostalgic feeling every time to be back to the institute, especially at the Brahmaya Hall, where I must have spent most of the time as a student. And in fact, today after a very long time, I went up to the first floor and the library brought back a lot of very good memories. A lot of, most of the time during my CPE days, it was spent at the library hall studying. So it's always great to be back here, and I convey my heartfelt gratitude to SIRC for giving me this opportunity. Now, the topic for today is Introduction to MLI. It's part of the Back to Basics series which is being hosted by the SIRC. So what we are going to see in this session is a brief understanding of what MLI is, important conceptual pointers that we have to keep in mind, and in the second half, my good friend Prasanna, he will be taking you through few case studies on how to read MLI along with the tax treaty. So this is how the session on MLI is structured for today. Now before we get into MLI, let us understand why we need an MLI. Right? Now all of us are operating in a global arena. Therefore, there is a requirement for laws to evolve, especially taxation laws, to evolve, keeping in mind the changing business environment, the changing global conditions that are in place. We cannot keep staying with the age-old legislation, because if we do that, then what happens is some countries may tend to lose, some countries may tend to gain. So in a global context, in an international scenario, it is very important that every jurisdiction gets its rightful share of tax. Yes, definitely, the taxpayers must not be subject to any hardship. They must not be subject to tax on the same income twice. They must be given relief wherever it is possible. The taxation should not come at the cost of promoting economic growth and investments. All these considerations are there, but nevertheless, it is important that a country gets its rightful share of taxes, because a person who is conducting business in a particular jurisdiction utilizes resources of that jurisdiction, and therefore he must pay that jurisdiction its rightful share of revenue. This is the fundamental background why the present changes in the international tax framework are evolving, and why a lot of changes we are witnessing. Therefore, to recognize all these needs, what happened as a first step was a double taxation avoidance agreements which was entered. But when DTAAs was entered, there were not large concerns surrounding tax avoidance, abuse of treaty, entities claiming benefits which otherwise they may not be entitled to, merely by structuring the transaction in a particular way. Those were not the concerns to start with. But as I was just saying, that as things evolved, these concerns assumed prominence, and therefore that necessitated treaties to be amended. Now we will see how these things are put in place, but the background is this. Now, in the context of India, we all know that the treaty making power to central government is given in Section 90. So, Section 90 permits the central government to negotiate with some other jurisdiction and enter into treaty. Central government enters into treaty. Is it immediately effective? Answer is no, because that treaty has to be notified. There is a requirement that after signing the treaty, it has to be notified, and only after it is notified, it takes into effect from the agreed upon date. Presently, the treaty governs taxability of different sources of income. Treaty contains clauses for exchange of information. Treaty says how to avoid double taxation. Treaty has certain clauses where certain benefits are conferred. Even though it may not result in double taxation, those aspects are covered in treaty. But after 2008, when the global meltdown happened, and countries started relooking at their legislation in a new perspective, they realized that large entities, especially large multinational corporations who have presence in multiple jurisdictions, they probably pay only about 1 to 2% of the total profits as tax globally. When a deeper study went into as to why this is happening, it was found out that these entities were indulging or were structuring their transactions, let me put it this way, structuring their transactions in a particular way so that they benefit out of exemptions that are there in some jurisdiction, they benefit out of lower tax rates in some jurisdiction, they benefit out of the specific provisions that are there in the tax treaty. Therefore, double taxation, which was a concern, that concern turned into double non-taxation. So somebody was not paying tax anywhere. That became a concern, and therefore that necessitated an amendment to be made in section 90 to extend the power for entering into tax treaties to also cover instances of double non-taxation. This becomes very important because only if this is addressed, the intention of entering into a treaty, granting a treaty benefit, promoting economic growth, promoting investment growth, all that is ideally met. So this is the background with which the amendment was made. Now, for double non-taxation, let me give you some examples how this has happened and why we are even concerned about the topic of MLI that we are speaking today. In all tax treaties, there is a clause for permanent establishment. All of us must be aware. Article 7 will talk about when tax, how tax should be charged wherever there is a permanent establishment. It deals with business profits. What constitutes permanent establishment is generally under Article 5. Now, let us take an Indian context. In the Indian context, somebody from outside India carrying on some business in India, maybe under the Indian law, it constitutes business connection, and therefore, if you strictly look at the Income Tax Act, you will say it is not taxable. But if one gets into the tax treaty, Indian context, you will say it is taxable. But if one gets into the tax treaty will say only when that entity has a permanent establishment in India, and if the income is otherwise not royalty or fee for technical services, only if there is a PE, it will be taxable in India. Now, what is a PE? If you have a branch office, if you have a factory, if your employees are present for a specified number of days, that itself becomes a PE. If you are carrying out any project or construction site, and if that project is carried out in India for a specified number of days, that itself is a PE. But every treaty has certain exclusions. I don't want to classify every activity as resulting in a permanent establishment, because only if a substantial activity is carried out in a jurisdiction, then only that should constitute a permanent establishment, and only then should that source country be entitled to taxing rights. Therefore, there are certain activities which are categorized as preparatory and auxiliary. These are not main activity which you carry on, but these are ancillary or incidental to whatever you are otherwise carrying on. So, every treaty lists down certain activities. For example, merely purchasing goods or merely collecting information for you to supply that information to a non-resident entity, or merely storing goods, merely delivering goods, merely carrying out marketing activities. These are all generally identified as preparatory and auxiliary activities. Some treaties say that these activities will not result in a PE. Blanket, no PE for these activities. Some treaties say these activities, independently you have to see whether it is actually preparatory or auxiliary. For example, if the marketing office in India could be a substantial activity for that business, that cannot be preparatory and auxiliary considering the scheme of things. Therefore, these activities can be preparatory and auxiliary, but you have to see whether it is preparatory and auxiliary, and then if it is so, it will not be construed as PE. Therefore, what was happening is to benefit out of what the treaty says, to stick to what the treaty says, yet not invite any tax implications. There could be scenarios where somebody could artificially split their activities. In this example, the entities in Australia, it incorporates 3 different entities in India. Holding structure could be different so that you may not even know how these are related also. So one entity is only carrying out warehousing and product delivery. One entity is taking care of marketing. The other entity does accounting and payroll. Probably, if all these 3 activities were to be aggregated into a single entity, that entity itself could constitute a PE of the Australian entity. But because it is being artificially split, somebody could take advantage of the 3P and therefore not have any tax implications in India. So this is one of the concerns of non-taxation. This is sought to be addressed through the mechanisms that are now being put in place through MLI, through BEPS action plans, etc. Another example is, let us say there is country A where there is no tax on dividend income. There is no tax on dividend income. Country B, which states that preference capital will be deemed to be debt. Preference share capital will be deemed to be debt. Now, an entity in country A invests in preference share capital in country B. Preference share capital in country B. Periodical dividend or interest, whatever terminology you give, that periodical payments is made to the entity in country A. For X in country A, it is dividend. For X in country A, it is dividend. But dividend is exempt. X is not going to pay any tax. But for Y in country B, this payout will be an interest payout because preference capital is considered or it is deemed to be debt. Therefore, Y will get deduction. So Y is getting deduction. Logically, X has to pay tax somewhere because X is getting this income. But X will not pay because in X's country it is exempt. Therefore, by going through the specific laws of each jurisdiction, one can structure the transaction and still take advantage so that they have tax benefit where they are enjoying tax saving in one country and tax exemption in another country. Thereby, this transaction also does not suffer taxation anywhere. In fact, it is loss of taxation because one country you have savings of tax also. Third example, sticking to the PE scenario, in the context of permanent establishment, you would have seen in certain treaties that permanent establishment also exists where employees are present for 180 days. That is, colloquially we call it a service PE, or where a construction site or a project site is also carried out and that is existent for 180 days also. Now, if that 180-day threshold is met, then definitely it becomes a permanent establishment and profits attributable to that activity, that permanent establishment, will be taxed in the source country. Let us assume that source country is India. Now, if I am an entity outside India and I am going to execute a large project in India, but I don't want this PE implication hanging on my head, what I can do is again artificially split the contract. There could be different components. There could be installation, there could be initial construction, there could be testing phase, supervision, etc. etc. Every contract will have multiple components. Split these components, host it in different entities so that each entity, their project duration does not exceed 50 days or 60 days. So each entity will have a project duration of 60 days, 70 days, but put together it may be more than 200 days, inviting the trigger of the PA clause. But independently, if it is not met, then in that scenario also there can be a concern for double taxation. So with all these concerns, it was felt that there is definitely a great need to revisit the old taxation rules. These concerns have to be addressed. These concerns have to be plugged in so that jurisdictions are not deprived of their taxing rights. At the same time, the taxpayers are not suffering undue tax in any jurisdiction. So these two objectives 2008, and then discussions were going on. What happened was the OECD along with the G20 nations launched an initiative called Base Erosion and Profit Shifting Project. Base Erosion and Profit Shifting Project. Why is it called Base Erosion and Profit Shifting BEPS? It's because by avoiding these structuring these transactions, avoiding taxes, taking undue benefit, etc., what happens is one country's tax base gets eroded and the profits get shifted to some other country where there is an advantage. Therefore, base erosion and profit shifting. So, as a first step, sometime in July 2013, a study report was given by OECD, giving different scenarios, enumerating different concerns. And then in October 2015, a 15-action plan was released. The first 14 plans, 1 to 14 plans, each of them deal with specific issues that has to be addressed. And in the plan 15, they talk about how do we address this? That is where they conceive a concept called multilateral instrument or MLI. Now, what is this multilateral instrument? Why is it needed? Now, we know that treaties have to be negotiated between countries, and any negotiation takes time. It is not going to happen in one day, but the concerns are existing for a very long time. Somewhere it has to see the light of the day. Somewhere we have to start implementing, because once we don't do that, those concerns may become redundant. Some new thing will come, and then it will be a never-ending project of just something being at the proposal stage itself without seeing the light of the day. Therefore, it was suggested that there should be a multilateral instrument. Which can apply to all jurisdictions. What it will save is, it will save the time it takes to negotiate a treaty. It will save the time substantially, because more than 2,500 bilateral treaties are there in the world. Imagine each bilateral treaty you have to sit and negotiate. We don't know when that is going to get over. Probably all of us may get very old by that time. So this is not going to happen. Therefore, it was felt that this is the best solution. It is a single document which will be signed by all those countries who are accepting to it. But you can ask a question as to whether once it is signed, is it going to be immediately effective? The answer is no. There is an inbuilt bilateral element in that, but that is not as pronounced, as profound as what it would have been had the treaties been negotiated by two parties. And every country, like India has to negotiate with Australia, India has to negotiate with UK, Spain, etc. It definitely is not going to take that much amount of time. We will come to how the MLI has to be read. We will come to all that. Now, this is just a fact sheet on the current status. When the MLI was launched, 2017, it was initially signed by about 67 countries. As on 2nd October 2004, which is the present data available in the OECD website, 104 countries have signed it. USA is not party to an MLI. It prefers to negotiate bilaterally. So USA is not a party. Now, once it is signed, that is not enough. Every country has to submit an instrument of ratification. What is that instrument of ratification? They have to say, so this is where the bilateral element that I said comes into play. They have to say, once you sign, which means you are predominantly in agreement with what is stated in the MLA. Then you have to say, are you agreeing with Article 1? Are you agreeing with Article 2? Article 3, Article 4, Article 5, etc. You have to say whether you are willing to apply each article. If you are willing to apply each article, you will say so. India has given a notification where it says which all article it wishes to apply, which all article it does not wish to apply, and then submit that instrument of ratification. Now, as on 2nd October, 104 countries have signed it, but 87 countries have submitted the instrument for ratification. India has submitted this on 2019. Now, this MLI is a document. It has to first come into force. It has to be a recognizable document. The Article 34 of the MLI says that MLI as a document itself. But that document has to have an entry into force for each jurisdiction. For each jurisdiction, it has to have an entry in force. So that happens on the first day of the month following the expiry of 3 calendar months after they deposit the instrument. That is for each country. Next, entry into effect. MLI is a recognizable document. Now, when will the provisions of the MLI start taking effect? When will it start getting applied? For a withholding tax provision, it will be 1st January of the calendar year after the MLI enters into force. For any other provision, it will be the 1st January of the calendar year after expiry of 6 months after the MLI enters into force. India is not familiar with calendar year. We operate on financial year. This is also recognized because some jurisdictions don't follow calendar year. Therefore, there was an option given for you to choose not calendar year but your own taxable period. Your own taxable period. India has chosen that. So, this is as far as entry into effect. And just one more point. This entry into effect, there was an option to defer it to 30 days after the country fulfills all the internal procedures. India has chosen that option also. Now, what is India's position? India has, before I come to that, so I told you that MLI, once it has to be signed, then it has to be ratified. In the process of ratification, one important step is there. The country has to say which all DTAAs it wishes to be covered under the MLA. Which all DTAAs it wishes to be covered under the MLA. Only those DTAAs will be covered. So, if India says that I want Australia's DTAA to be covered, Australia should also say I want India to be covered. If India alone says, Australia doesn't say, it will not be covered. And once both of them notify or recognize that DTAA, it will be called a covered tax instrument. Covered tax instrument. When it becomes a covered tax instrument? Only when both parties wish that the other country's DTAA to be covered under the MLA. So, India has covered or notified 93 DTAAs. China is not notified. In fact, some of the BEPS related measures are incorporated now. Iran, the treaty itself came into effect from 2025 and one more Marshall Islands, India has not notified that. And 4 countries did not notify India: Switzerland, Germany, Mauritius and Oman. So, with respect to these 4 countries, because they did not notify India, the MLI will not be applicable for those jurisdictions. So, this is very important. Covered tax agreement means both people. Similar to contract act, when we say consensus ad idem, the party to a contract must understand the contract in the same manner. So, similar to that concept, both countries have to notify each other. So, this is basically the structure of MLI. In MLI, there are 4 action plans, BEPS action plans that are covered. One is hybrid mismatch, other is treaty abuse, permanent establishment and dispute resolution. Dispute resolution, when there are disagreement between 2 nations on how to apply a treaty or on any matter, any issue which is a subject matter of treaty, then how do you resolve that dispute? Permanent establishment, treaty abuse, we saw some examples. Hybrid mismatch, one example is this tax transparent status. Now, what is tax transparent? India, we have partnership firm. We all know that partnership firm is not a legal entity. If you enter into contracts, partner will enter into the contract on behalf of the firm. Whereas for a company or an LLP or a company on its own, they have a legal status. But partnership is not so. But partnership is considered as a person for income tax purposes, and therefore we file return for partnership firm, we comply with all requirements for a partnership firm. There are some jurisdictions where a partnership firm is not considered as a separate taxable person. The partners who are at the helm of affairs, they are only considered as separate entities, and therefore whatever is earned at the firm level will be taxed only at the partners level. Whatever is earned at the firm level will be taxed at the partner level. This status where a particular entity form is not recognized, that is called tax transparency. That is called tax transparency. That is there in some form in our law also. For example, mutual fund. For the mutual fund, income is exempt. The income is taxed in the hands of people like us who are investors. At the fund level, mutual funds is always formed as a trust, never as a company. At the fund level, the income is exempt. So, some form of tax transparency is also embedded in our law. So, what happens when there is tax transparency? Let us say there is a partnership firm in India which is rendering some services, some technical services outside India. Now, outside India, this partnership firm is not a separate legal entity. The partners will be subject to tax outside India. Tax will be withheld or tax will be paid by the partners. What should the resident country do? Resident country may say that I cannot give credit. The tax is not paid by this entity. According to me, this entity is the taxable entity. Tax is paid by the partner. I cannot give credit. So these kind of issues are also sought to be addressed. Where because of tax transparency, either a taxpayer could suffer or a taxpayer could take advantage by setting up the transparent entity in a jurisdiction where the environment is otherwise friendly but transparent status is there, therefore no taxes are required to be paid. So this is one of the issues that is sought to be addressed in hybrid mismatch. And the MLI presently covers guidance which is given under these 4 plans, which is Action Plan 2, Action Plan 6, Action Plan 7 and Action Plan 14. Now what does an MLI do? Okay, we have understood what an MLI is. MLI India has signed, India has submitted the instrument of ratification, India has notified Australia, Australia has notified India. Now what happens? What is this instrument? What do I do with it? This MLI has to be read along with the DTAA. This MLA has to be read along with the DTAA. Therefore, DTAA will operate, MLA will also operate. Now, because MLA is there and whatever provisions are there in MLA applies to DTAA, so is there no need or should treaty still not be negotiated? Answer is no. India and Australia or any 2 countries can still bilaterally negotiate, probably put more stringent clauses than what is suggested by OECD. Those things can still continue to happen, but when MLI applies, it will apply alongside the double taxation avoidance agreement. It will not amend the double taxation avoidance agreement, and it has to be read together with the DTAA. So this is what I said, what can be a covered tax agreement. Both countries must notify each other, only then it will be a covered tax agreement. Now, there could be some terminologies in MLA which are not defined in MLA. The document itself gives a guidance saying that for those terms, you can take reference to the DTAA. If DTAA also does not define those terms, then taking recourse under the DTAA, you can understand what the term means by looking at the domestic law. But all these things have to be done keeping in mind the context with which the MLA has been instituted. If you look at section 2 of our Income Tax Act or any definition in any law for that matter, it will start by saying that unless the context otherwise requires. This is the meaning you have to give for the terms. For different words that are used, different expressions that are used. So unless the context otherwise requires becomes important. So only when the context requires, you have to apply this. If contextually the definition should not be applied, notwithstanding that the definition may be there in the DTAA or the definition may be there in domestic law, you should not apply. Now, how do you know whether context otherwise requires or not? You have to read the MLA along with the explanatory statement which is issued. This explanatory statement draws the intent as to why this MLA is needed, what is sought to be addressed to various clauses. So, if you see it together and if you contextually look at things, only when the definition serves the purpose of MLA, that definition should be applied. Otherwise, it has to be interpreted in good faith. Every treaty entered into between 2 countries has to be interpreted in good faith. That comes out of Vienna Convention. Even though India is not a signatory, this principle principles of Vienna Convention has been well recognized, and treaty interpretation continues to be guided by what is stated therein. If you read the text of MLI, there are different phrases that are used. There are different phrases that are used for each article. What happens? In this case, what happens if both countries notify? What happens if one country does not notify? All those things are covered. Common terms which are used are in place of. It will say that once countries notify, this article will apply in place of. So, what does that mean? So, when you are looking at DTAA, let us say you take Article 7 and the MLI becomes applicable for that article, let us say Article 7.1. Now, MLI becomes applicable, MLI uses the phrase in place of. Therefore, instead of whatever is the Article 7.1 which is there in the treaty, you should read what is there in the MLI into the treaty. So, in place of. This in place of rule will apply only when there is a related article already there in the treaty. It will not apply otherwise. Only if a relevant article is already there, you will replace that. DTAA will not get amended again. This is a separate document. When you read, you have to read it together. The second phrase which is used is applies to or modifies. Applies to or modifies. Here, the article will not be replacing what is there in the CTA or the DTAA. To the extent of variation, to the extent of incongruence, what is there in the MLI will be read into the DTAA. The third expression which is used is in absence of. Therefore, when there is a particular clause which is absent in a DTAA, only then this will apply. Where a relevant related clause is already not there in the DTAA, then whatever is there in the MLI will be read into it. The next phrase is in place of or in absence of. So, this covers both scenarios. Scenarios where a related article is there in DTAA, scenarios where a related article is not there in DTAA. In both these scenarios, that MLI relevant article will be read into the DTAA. Now, this MLI requires certain articles to be, we said that once CTA is notified, treaty is notified. Now, each article, every country has to say, do I accept, do I not accept, do I accept, do I not accept. There are certain minimum standards. The MLI requires that, first you have to, bare minimum accept this. You cannot say I will not accept this. So, Article 7 which governs preamble text of the DTAA, 6 and Article 7 which carves out a principal purpose test, those are minimum standards. We will come to what is principal purpose test and all, I will give you a background. In certain articles, there are certain powers granted to the treaty partners to make reservations. I can say, no, I don't want to apply this. I don't want to apply this article. Or I can say, I want to apply it, but with certain modifications. Or I can say, no, I don't want to apply it, but not because I don't accept what is stated there, because my own treaty has a better article. My own treaty has a better clause which is more stringent than what you have drafted. So, these kind of reservations can be made. Whether you can make reservation or not, you have to see each article. What reservations are permitted to be made therein, and only that reservation you can make. In certain articles, you have options. They will say that a country can choose either A, B or C. So, you can choose whatever option that you are comfortable with. But it is important that other country also chooses the same option. You choose option A, other country says I don't want option A, option C, then that option will not apply at all. Similarly, wherever you are making reservations, if a similar article is already present, he said that where a similar article is present, the MLI article will replace that. Where a similar article is present, you are also required to tell which is that similar article. So, if you look at the notification which is given by India, if you go back, download and see it today, it will say Article 7. I will notify the following articles in the DTAA. So, you have to say which is the article which is already there in the DTAA, and you should say that, okay, this is the article. Now, this article I am willing to replace it with MLI. So, you have to say that. If you don't say which is the article, then even though that country may be notified, that agreement with that country will constitute a covered tax agreement, still that MLA provision will not apply because you have not said which article you want to replace. So there are multiple, so even though it is multilateral, there are certain bilateral elements. Similarly, you have notified Article 7.1 that other country should also say Article 7.1. If that other country says some other article, then that becomes a different scenario because it results in a notification mismatch. It results in a notification mismatch. How should you apply MLA in case of a notification mismatch itself is a big question. Whether you will say it will not apply or you will say it will apply, but only where the DTAA is saying something contrary to MLA. It will not replace because there is a notification mismatch, it will not replace, but only to the extent where it says something contrary, only then it will apply. Now, the OECD website has a very beautiful tool where they provide a matching database. If you go to the OECD website, you will find a matching database. You can, I will select India and UK. I will select India and say Slovenia. It will say whether it is a covered tax agreement. Have both countries accepted it is a covered tax agreement? Article 4. What is India's position? India has made reservations. Australia has not made reservations. Therefore, this article will not apply. Article 5. What is the position? So, it's a very beautiful tool. Anybody who wants to immediately see what is the present status, this tool is complete guide in itself. You can just go to the OECD website and see as to how it operates. Now, with this background, now let us just briefly see what are the different. Now, Article 1 covers scope, Article 2 covers definitions. Definitions is where they say that wherever their term is not defined, go to the CTA. If it's not defined there also, CTA permits you to go to the domestic law, but only where that definition can be applied in the context and in the spirit of a MLA. This hybrid mismatches, two articles are dealing with it. Hybrid mismatch is the transparent entity example, that partnership form example that I gave, Article 3 and Article 5. And treaty abuse is dealt with in Article 4, 6, 7, 8, 9, 10 and 11. And avoidance of PE. Avoidance of PE, we discussed this example of fragmentation, splitting contracts so that different days are in different entities so that you don't fall within the provisions of a permanent establishment. That is in 12, 13, 14, 15 and dispute resolution is in 16 and 17. So that's just a brief background on how each of the BEPS action plans which are covered under the MLI are made, covered under the BEPS are made part of the present MLI. Now, this is important for us to understand what is India's position, because that is, at the end of the day, we are all practicing here, so we have to understand what is India's position with respect to each article. Now, Article 3, transparent entities, India has said, I don't want, I am not going to apply this. So, this will not apply for any country with which India has a covered tax agreement, even though the other country may accept to Article 3, because India has not accepted, it will not apply. Now, this Article 4, this dual resident entities, India has not expressed reservation, so this will apply. Basically, what it says is, where somebody is not in, what is dual residency? I qualify as a resident in India, I also qualify as a resident in some other country because of the residency rules there. But if I qualify as a resident in both jurisdictions, it is not going to work out. There has to be a tiebreaker. There has to be a tiebreaker, and I must be it must be decided between both jurisdictions that yes, for A, B, C, D reasons, this entity is a resident of your jurisdiction only, not my jurisdiction. So let us resolve it like that. But it is not as simple as we are speaking here. There are multiple combinations, there are multiple factors which have to be considered. That's how the concept of place of effective management got evolved. Find out where is the place of effective management. How to find out where is the effective management itself is $1 million question. Right? So, this article says that if somebody is other than an individual, then the dispute as to where he is a resident, you can resolve to mutual agreement procedure, where basically two people sit across a table, decide what are all the crucial factors, then arrive at a consensus on where this person should be a resident. So this article India has accepted. This next is Article 5, which is methods of elimination of double taxation. There is a very interesting point here. Here there are 3 options which are given. Now for elimination of double taxation, we all know that there are 2 methods, exemption method and credit method. But MLI predominantly advocates only credit method. Now predominantly advocates credit method only. Option A and option C are giving scenarios when exemption method should not apply. India logically did not invoke option A, option B, because most of the treaties entered into by India with other countries only consider credit method. Credit method means you have paid taxes some other place. I will give you credit for those taxes just like you get TDS credit. Exemption is you have paid tax on that income there. I will not tax that income again here. That is exemption method. But most of the tax treaties, except 4 of them, have only credit method in place. Therefore, India logically chose option C. Now, we just saw a while ago that if a particular article in MLI gives options and I choose one option, the other person should also choose the same option. This is an exception to that rule. This article says if you choose option C and he chooses option A, option C will still apply. How will it apply? It will apply for your residents. So when your residents are applying the treaty provisions, option C will apply. But it will not apply for the other countries. So it is not a blanket case where no option will apply. Option C will still apply for the residents of India. Now, in cases where the DTAA or the covered tax agreement contains an exemption method and both countries have notified option C, that exemption method will be replaced by this. That exemption method will be replaced by this. For example, DTA with Bulgaria or Slovak Republic, exemption method is there, but both countries have accepted option C. Therefore, exemption method will be replaced by option C, which is credit method. So, therefore, it becomes very important that when we are advising a client, we have to also keep in mind this MLI. Right now, things, it may not be of much impact to a very small player or a small business, but nevertheless, we have to keep this in mind. Going forward, the changes that are going to come, the ramifications that we are going to see, knowing the DTAA entirely, knowing how to read the DTAA with MLI, and going forward there could be multiple other, there could be probably another MLI also, but we don't know, or this may be modified. So this fundamental on how we are going to understand this becomes very crucial. Article 6 is a modification to a preamble to DTAA. Basically, whatever Article 6 says, it is already incorporated in Section 90, by way of an amendment. Section 90 earlier said that you can enter into tax treaties for avoiding double taxation, for granting relief, for exchange of information, for promoting investment, etc. Now, another objective for avoiding double taxation, for avoiding treaty abuse. All these things are added. Article 6, which is preamble to the treaty, also states that this is a minimum standard. Therefore, India has not expressly said anything, but this will apply provided the other country also agrees to it. Article 7 is preventing treaty abuse. Now, we are all aware that India also has this GAR provisions, anti-avoidance rules. This is something similar to that. You have to see a particular transaction, see why that transaction has been entered into. If the predominant or the principal purpose of the transaction is to get any tax benefit. Logically, let us say somebody sets up a subsidiary in some tax haven. Logically, nobody will set up because there are no enough resources for you to carry out that business which you are intending to carry out. Labor issues are there, political issues are there, environmental concerns are there. There is no reason why an entity with a reasonable mind, with a rational mindset will go and set up entity in that place. But you have set up. Why you have set up? Probably because there is some tax advantage in the treaty. Therefore, if it is discernible that a treaty, a particular transaction is entered into to gather or garner any tax advantage, if you find that the principal purpose itself is to obtain that, then this constitutes treaty provisions being abused and you can be denied the benefits of treaty. This principal purpose test is again a minimal measure, minimum standard. Therefore, this has to be adopted. And India says that I am adopting this principal test as a minimum measure, as an interim measure only, because I want to have an exhaustive test in all my treaties. I want to renegotiate. So till I renegotiate and treaties are amended, I will apply. You have said this is a minimum standard, I will apply, but I'm making a point that I don't want this to be a permanent measure for me. I only want it to be an interim measure. Along with this interim measure, the MLI also suggests something called a limitation of benefits. What is limitation of benefits? The certain benefits contained in the treaty will not be given to you in certain circumstances. For example, if you do not carry out active business, what is meant by active business? I must be rendering an actual service. I must be manufacturing. I must have some activity going on. I must not be a mere holding company. I must not be a mere financing entity. Because these entities are not carrying out any real activity, but these entities are only merely existing probably as a shell company or as a conduit company. For those entities, there will be certain benefits which are not given. So, this limitation of benefits, a detailed limitation of benefits was suggested in the BEPS action plan, but to begin with, a simplified form has been incorporated into Article 7 and India has accepted that it will apply this. Then this Article 8 on dividends. Now to encourage investments, it also becomes important that certain investment related incomes are taxed at a beneficial rate. But that beneficial rate cannot be given to anybody and everybody. It has to be given to only somebody who is committed to that investment. I invest today, I take out my money 10 days later. I cannot be given a beneficial rate for dividend. But most of the treaties do contain certain benefit as far as dividend income is concerned, and that is because they want to attract cross-border investments. They want to attract more capital into their country. So this article says that this dividend benefit, any lower rate of dividend will only apply if you have stayed invested for the minimum period. If you have stayed invested for the minimum period, which is 365 days, which is given in the treaty. India has accepted to it, but it has made a reservation with respect to India-Portugal because there the condition is more than 365. The existing clause is more stringent, so I don't want to dilute it by applying the MLI. Now, Article 9 deals with capital gains on alienation of shares. This is very interesting. Now, we all are quite aware that in the Income Tax Act, there is a provision already in Section 9 where if you are transferring shares, let us say there is an entity in country A, country B and India. Country A sells its shares in country B to some other person. Any connection with India? No. Country A, country B selling it to somebody in country C. No connection with India. But country B has invested in India. Country B has invested in India, and in India there is a manufacturing entity. Country B entity does not have any activity. All its share value is derived from country A. India. All its share value is derived substantially from the balance sheet of India. So there it will be treated as if that capital asset is situated in India. Only when a capital asset is situated in India, only when you are able to establish a nexus with India, can you tax the transaction in India. Country A, country B, country C, no link to India, but this is the link that the legislation has sought to draw. Similarly, when you are transferring shares which derive their value from an immovable property situated in some other country, then that country becomes the source country. That country should become the source country. That country should get the benefit. But what happens is, okay, you say minimum 50% immovable property value should be there in India. okay, just before the transaction is happening, I will do some other transaction to make this value below 50%. To make this value below 50%. So, by this way, certain treaty advantages were sought to be garnered by certain entities. So, this is also attempted to be plugged by MLI, which says that within 365 days, if you are having that 50% at any given point in time, then that country where the immovable property is located, that country should be getting some taxation rights for this transaction. Because if more than 50% value is derived from immovable property, it is as good as that income is immovable property income. It is as good as, even though you are selling shares, it is as good as you have benefited out of the appreciation in the value of immovable property. Therefore, that should be treated like any other income arising out of immovable property. So, this is Article 9. Next is this, there is anti-abuse rules where PE is there in the third country. Let us say this is India, Australia, and PE is established in a third country. India is the resident country. Source country is Australia, but PE is there in a third country. Now, assume that the treaty says that this transaction India will not have taxing rights. Then the clause says that you see what is the tax rate which is paid in that other country. If that is 60% or more than what tax you would have otherwise paid here, then no problem. Otherwise, this benefit cannot be granted. This benefit cannot be granted where there are 3 countries that are involved. Next is Article 11, which restricts the right to tax own residence. Basically, that is the demarcation of source and resident. Wherever source country has to get taxing rights, resident country should exclude itself. Resident country should say that yes, for this particular activity, I agree that the other country deserves the taxes, so I will not tax my residents. So, scenarios where the taxing rights will be restricted for own residents. So, India has not expressly said anything, therefore, it has not accepted, it has not reserved also. If the other country notifies India's DTAA, then it will apply, otherwise this article does not apply. Unless reservation is made by the other country, it will not apply, otherwise generally it will apply. Then artificial avoidance of PE to commissioner agreements. In the DTAA, which all of us have come familiar with, be it any country, there is a clause which says that PE will be created even in a situation where you are operating to an agent, to a dependent agent. You are operating to a dependent agent, and that agent exercises authority on your behalf, concludes contract on your behalf, and carries out everything just the way you would have carried out. So, wherever an agent is operating under authority from a principal, that agent will also constitute a PE of the principal. Agent will also constitute a PE of the principal, notwithstanding that there may be a separate place of business. All those things are not required. Now, this is again, in some treaties it will say that if you are an independent agent, then you will not constitute a PE. Who is a dependent agent, who is an independent agent itself is a subject matter of lot of debate. Certain tax planning that are being done to avoid this. For example, I will substantially negotiate everything. Agreement will be signed outside India. I will say that I am not negotiating the entire contract, I am only negotiating 1 or 2 aspects, but he is only responsible. So, by fragmenting few portions, by saying that only this activity I do, that activity I don't do, PE was again avoided to artificial structuring. So, this particular article deals with such scenarios where people avoid constitution of a PE by appropriately structuring or modifying the terms of arrangement. This is Article 30, avoidance of PE through preparatory and auxiliary activities. The first example that we saw, where there are 3 entities, one entity is doing warehousing and delivery, one entity is doing accounts and payroll, other entity is doing marketing. Now this article gives 2 options. One, you see whether each transaction discussion has to be is preliminary and auxiliary. Don't just because it is warehousing, don't conclude it is preliminary or auxiliary. See in the context of that business, what is the role of warehousing? What is the importance of warehousing for that business? And if warehousing forms a significant part of that business, it will not be preparatory or auxiliary. So see each and every activity. Second option is don't test each and every activity whether it is preliminary or auxiliary. If the treaty says it is preliminary or auxiliary, go by that. And India has chosen option A, and India says that no, I want to test each activity. But again, it is important that the other nation also accepts option A. Only then it will apply. Article 14, again the example that we saw, where there is artificial splitting up of contracts as a result of which PE is not constituted. So again, India is silent, therefore it applies unless the other nation has expressed reservation. There is a definition of closely related person, one controlling the other, 50% holding, etc., etc., etc. That definition, India, it will apply. The moment you have consented to applying Article 12, 13, 14, this definition will apply. Therefore, India is silent on this. Article 16 is mutual agreement procedure. This is a dispute resolution clause. What happens when there is a dispute between the treaty partners? How it should be resolved? So, mutual agreement procedure is basically people coming together, sitting across the table and deciding how to end this conflict. So, India says that yes, I am agreeing to this, but I would prefer to have a bilateral consultation and a notification process for dispute resolution. Article 17 is corresponding adjustments. Now, we will all be aware that in transfer pricing, in India under law, you can only make an adjustment which results in increase in total income. You cannot make an adjustment that results in decrease in total income. That is not permitted. Therefore, by applying transfer pricing regulations, transactions between two related parties are benchmarked and they are seen whether they are at arm's length. If they are not at arm's length, an upward adjustment can be made. So, if India makes an upward adjustment, then some other country should give that benefit. I have paid more taxes in India. Some other country should give a corresponding adjustment, should give a corresponding deduction. That is only logical in the scheme of whole things. So, this particular corresponding adjustment to be given wherever one country makes a transfer pricing adjustment, that is dealt with in this article. India has expressed reservation because my treaties already contain certain checks and balances for this. Therefore, I have expressed reservation. Then Article 18 to 26 is mandatory arbitration. So, wherever disputes are not to be resolved, go for a mandatory arbitration. India has not accepted to mandatory arbitration of dispute resolution. While MAP, it says mutual agreement procedure, I am okay. I prefer a bilateral negotiation, but I am not okay for a mandatory arbitration. So, this is as regards overview of what is a multilateral instrument. Now, as tax practitioners, it becomes very important that things are evolving globally. Now, BEPS, there is 2.0, there is Pillar 1, Pillar 2, and we, in the last 10 years, if you look at how the Income Tax Act itself has evolved, we had equalization levy, we had significant economic presence, we had section amendments made in Section 9. Things in the global context by the OECD kept evolving. Lot of published reports on how to revamp taxation laws, to how to address digitization of economy, how to devise taxing rights in the context of how things are developing, moving from the old traditional system of a company being there like this, brick and mortar, and carrying on business, to I am sitting here, I am using internet and I am earning income from almost all the nations around India. So that is the fast pace in which things are moving, especially in the last decade. So as tax practitioners, it becomes very important for us to keep ourselves abreast with what is happening, because that will help us become prepared, and when eventually all these things are put in place and all these things are coherently built and it starts getting applied. Now MLI, things are already applicable, but with not in the same intensity and force with which otherwise we would have wanted things to be put in place. So when that happens, it becomes important that we are not behind. We have to stay on par with the global arena. So that becomes very important. So this is a background in which I believe these sessions have also been put. And any questions I'll be happy to answer. And I would like to thank all of you for the patient listening. And it has been again wonderful having you as audience. Be happy to answer any questions or any feedback. So TDS principles will remain the same. So as Sir was already saying, 195 will apply wherever income is subject to income is chargeable to tax. Okay, that principle will remain. Whether something is chargeable or not, you will look at the DTAA. You will read together with the MLA. If at all there is a exemption or something carved out, then it will not be chargeable to tax. The moment something is not chargeable to tax, 195 will not apply. Again, if there is a beneficial rate flowing from somewhere, then that beneficial rate can also be applied for tax deduction only for 195. Only for 195. For some other section, like if you remember the Spilcom Supreme Court judgment, which dealt with I think one other section, I'm not able to recollect, where payment was made to a non-resident sportsman, and that section specified the rate. For those kind of sections, you have to go by the rate. You cannot apply 195 because 195 uses two expressions: chargeable to tax, rates in force. Chargeable to tax, rates in force. Chargeable to tax means subject to tax under section 4.5 of the Income Tax Act. Whether it is subject to tax under 4.5, you have to read it together with the DTAA, because DTAA section 92 says that the provisions of this act, the Income Tax Act, will apply only if it is beneficial. Only if it is beneficial, Income Tax Act will apply. The moment a treaty is entered into, treaty may not have the same sanctity as a parliament legislated law, but it is same by the entered into by the government. Treaty provisions will apply, but wherever law is more beneficial, then only law itself will apply. Therefore, something is not, India does not have the taxing right for an income, treaty will, the 195 provisions will not apply. 195 principles don't undergo any change because of MLA. What you have to remember is, whenever you are reading any DTAA, you should keep in the back of your mind whether there is any impact because of MLA. Any impact because of MLA. Now, this some of the countries, in fact, if you go to the income tax website, you will see something called a synthesized test. Not the e-filing website, the other website, which will contain the Income Tax Act rules and all. You will see something, wherever DTAA is there, you will see something called a synthesized text. That synthesized text is nothing but incorporating MLA related provisions also for ease of our reference. Synthesized text is not a mandate, but countries have started doing it to make a ready text available for all its residents. So those principles will remain, sir. That will not undergo any change.
The post-lunch session. The session will be about impact of MLAs on DTAAs and recent judicial precedents on international taxation. CAK Prasanna is going to handle this session. A brief introduction about CAK Prasanna. Prasanna is a chartered accountant and commerce graduate with more than a decade of experience in corporate and international tax and transfer pricing. Prasanna has extensively advised clients on inbound and outbound structuring, holding jurisdictions, and business model evaluation. He also has extensive experience handling corporate litigations. He won the FIT Fellowship Scheme from Foundation of International Tax for 2018 and 19. He is a regular speaker at ICAI study circles and the International Fiscal Association, and has contributed articles on contemporary issues. He has contributed to the book on demystifying Section 194R, published by Tax Sutra along with CTC. Welcome, sir. So present this memento and return this all to the speaker.
Sir.
over to the speaker.
Good afternoon, and all. I thank the SIRC for giving me this opportunity. While the earlier speakers would have laid about some amount of the background about multilateral instruments, and before that we also had a session on 195 with regard to withholding. As a part of that, we would have seen some aspects of how the tax treaties operates. Now, my earlier speaker would have laid out the roadmap with regard to what led to multilateral instruments. Just to give a fair idea about this, if you look at before 2010, right about the emergence of base erosion and other action plans, there were a lot of hue and cry with regard to the way the multinational enterprises were operating, and majority of the cases where the developing countries were not meeting their fair share of taxation. Why? Because there is a road to race to bottom, in a sense where you are able to structure your operation in such a manner, the significant value chain is contributing to the profitability is located or has been structured in a low tax jurisdiction as compared to high tax jurisdiction where you generate more profits. So if you look at the majority of the companies, top 5 or top 10, are all dealing with electronic commerce. Say for example Google, Amazon of course they are into sale of products as well, but their main scheme of business is through e-commerce platforms. You do have Facebook. One may wonder, what do I get from Facebook? What sort of income that they generate? If you look at, they don't sell any products. So the more the time you spend, more the revenue for them, because they take all the user data, that what is the concentration or focus of the users when it comes to those concentrations has been populated, data has been monetized in the form of they selling the data to other companies through which they are placing the ads. So the moment you go and search something on Google or something on Amazon, later part of the time, even when you are let's say looking at some other mails, you get an advertisement stating that, hey, you looked at this particular product, do you want to buy it? So where do this data comes from? It is based on the amount you spend. The quality time that you spend on these sort of websites will enable them to monitor what is the focus area of this particular person. Based on that, they will be able to analyze the data and get the data, monetize that through other companies where they are trying to sell the products. So, huge amount of consumers or customers are all in developing continent, but what is the end result of this? The developing companies were not able to meet out their taxation. In case of a brick and mortar, if one were to look at, it's easy to tax the company because the company has to be physically located in a particular jurisdiction for them to tax it. Whereas in case of an e-commerce platform, it is difficult to identify a situs of that particular company or particular operation. So therefore, I may structure my transaction in such a manner that derivation of situs of a particular value chain, where it is located, it is difficult to be identified. So therefore, this leads to a task force formed in 2013, which they want to address digital economy. So therefore, there is a task force which constituted in 2013. Then they submitted an initial report. Then came BEPS action plan 2015, which spread across 15 action plans, out of which 14 action plans were concrete. The action plan 1, which dealt with digital taxation, was only a draft stage. They said further work is required. 2018, still it is an interim report, further work is required. Till now, if you look at, there is no consensus with regard to how do I tax the digital economy. Now we are moving to a pillar 1 or pillar 2 kind of a model to tax these sort of companies. Now you remained with rest of the 14 action plans. Out of these 14 action plans, some of the action plans requires amendment to the domestic law. Say for example, action plan dealing with harmful practices with regard to IP or any of the tax havens, which requires domestic law amendment. Interest limitations. We do have a corresponding amendment with regard to section 94B, where if your interest paid to associate enterprise is in excess of 30% of an EBITDA, then the excess interest that you have paid will not be allowable as a deduction, but you can carry forward for a period of 8 years. As long as your overall interest paid is within this 30% limitation, then only you are entitled for this deduction. Likewise, you do have certain amendments which requires treaty amendment. We were discussing just before the session, it took 30 years for us to negotiate a tax treaty with US. It took us close to, the Mauritius treaty was negotiated way back in 1996, but the next amendment took 21 years. 2016, we have entered into a protocol wherein the right of taxation between Mauritius and India with regard to capital gain has undergone some change. So therefore, if I were to implement some of the action items which are prescribed in the action plan into the tax treaty, then the amount of time that I have to take with regard to amending each of the tax treaty is enormous. So therefore, likewise, if the other countries, now there are close to 106 odd countries have signed the multilateral instruments. 3,000 tax treaties amongst these countries. Imagine the amount of time that it will take for each of the countries if they were to independently on a bilateral level negotiate these tax treaties. Not possible. So therefore, they come up with a mechanism, okay, I do have an umbrella document wherein I give you some sort of a leeway, facilitation. Say some of the provisions you may like it, other country may not like it. So therefore, I will come with the flexibility options wherein at a single stretch, I will be able to negotiate or amend the tax treaties. That is the main purpose of which the MLI document. Now this MLI is bifurcated into several articles. Some of the articles the earlier speaker would have highlighted, but for the crux of it, how do I read the MLI? Like I said, Article 2 of MLI is of paramount importance. Similar to our any of the bilateral treaty, let's say for example India-US. India has entered into a treaty, both of the parties have signed, and both the parties have some protocol requirements that the treaty has to be notified in the official gazette, then the treaty comes into force. Likewise, how does an MLI impact a particular treaty? Take for example, India has signed an MLI. They have, in Article 2, they would have given you a list of countries in respect of which they want to apply this. I will just show you. Now this is the speed change on this. So if you look at, this is the India's position on MLI, where as a part of this MLI document we have to give what are all the provisions which we want to opt what are all the provisions which we want to reserve for, or which are the provisions we don't want to include as part of our tax treaty. Now if you look at Article 2, interpretation of terms, here we have to notify which are all the tax treaties we want to cover as part of MLA. So Article 2 is nothing but which are all the treaties you want to cover it as a part of cover tax agreement. We call it as CTA, cover tax agreement, that India wants to cover. Likewise, the other country will also file, say for example in this case France, they would have filed the list of tax treaties which they want to cover as a part of MLI. So likewise I have to go and search whether India has notified France, likewise France also notified India. If both the countries have notified each other, then that becomes part of MLI and it becomes a cover tax agreement. So the moment it becomes a cover tax agreement, with regard to each of the articles, there are certain positions which each country may favor. There is a flexibility, like I said, in the MLI, whereby either of the country may choose to apply a provision or walk away from the provisions. So if both the countries have opted for a particular provision, then that particular provision will be applicable to the tax treaty. So therefore, to the extent we have to read tax treaty, India's position, in this example France position, whether there is a matching between these provisions. Once there is a matching, then you take it to the treaty. But hold on, there are certain other provisions where it does not require a matching concept, which we will deal with as we progress. Certain important aspects, if you look at minimum standard. These clauses, if you look at, whether you agree or not, it has to be part of your tax treaty. But minimum standard itself is classified into two ways. One, mandatory. Second, comes with certain relaxation. Say for example, Article 6, 17, 16 and 17. These four articles, when I mean article as per multilateral instruments. These four articles are minimum standards. But between these four articles, you do have a relaxation. Article 6, no relaxation. Whether you want to notify or don't want to notify, it doesn't matter. It's get added as part of your tax treaty. Article 7, there is an options that has been given. You can choose any of these options. We will deal with the later part of it when we come to it. Likewise, Article 16, which deals with mutual agreement procedures. There also there is a leeway that has been given. Despite that being a minimum standard, there is a leeway. Article 17 deals with corresponding adjustments, similar to the tax treaty, which has a corresponding adjustment. Whenever there is a transfer pricing additions which has happened, the main fundamental aspect with regard to corresponding adjustment is, I want to avoid jurisdictional double taxations, right? So if the same transaction is getting taxed in two jurisdictions, it should not happen. So therefore, there has to be a corresponding adjustments. So to the extent this will have an interplay with regard to transfer pricing provisions. Then notification is a certain requirement which is envisaged in each of the articles. I'll take you to each of the articles wherever there is a need for notifications. Like I said, there are optional provisions. Article 5, there are options that are given. Article 7, there are options that are given. Article 12, there is an option. Article 13, there is an option. So back and forth you do have several options. So each options, one country may exercise the option, another country may not want to exercise that option. So therefore, with regard to options, how do I apply multilateral instruments? Each article will have its own language. So we have to be carefully read those language to understand how do these optional provisions work. Reservation is nothing but I don't want to apply a particular article in entirety or in parts to a particular country. Reservations could be article wise or specific to country as well. Compatibility, we will just come to it in a moment. When does it come into effect? There is a specific provision which talks with when does a MLA come into effect. This coming into effect is with regard to each tax treaties. So we should look at not only our notification, we should also look at the other country's notification. When does they have notified MLA? Because if you look at 7th June 2016, when the MLA was initially signed, there were only 70 countries. Now we do have 106 countries are committed to sign the MLA. So whenever the initial deposit of options that has been notified, it is provisional. Then there were time that was given to each of the countries. You go back, if they want to change any of your provisions, you change and file a final deposit of instruments with the Secretary of the OECD. So therefore, if you have to look at what has happened between provisional notification of the MLA by India as compared to the final ratification, couple of changes we have also done with regard to Action Plan 7. Initially, we have opted principal purpose test plus SLOB. But when we filed the final ratification, we wanted to use principal purpose test as an interim measure. There is a change. So there is a flexibility even for countries to notify. So you can have a provisional notification, then you can go back, think around and deposit the final documents. Now once I deposit the final documents, can I change the provisions? Can I withdraw from something? There is no provision for once it has been final notification is done, I cannot withdraw any of the provisions. What I can do is, I can bilaterally negotiate with regard to a particular treaty and can bring some provisions at par with MLA or maybe severe than MLA. You would have seen the recent protocol related discussions between India and Mauritius. India wanted to notify Mauritius as part of covered tax agreement, whereas Mauritius has not opted to notify India as a covered tax agreement. So I have notified, the other country has not notified. So therefore, does it become a covered tax agreement for MLA? No. But what they did, they entered into a bilateral treaty by which they amended a particular provisions. They brought in limitation of benefits clause, which is compared to a principal purpose test. Although this particular protocol, which was entered very recently, is not in force yet, but there is an action that has happened from India's side. Say for example, India-China. India has not notified China as a part of covered tax agreement, but nevertheless, we have bilaterally agreed between India and China and got several other provisions that are at par with a multilateral instrument suggestions. So therefore, amendment is possible, only you can do bilaterally. Whatever provisions which you have already submitted cannot be withdrawn. It can become invalid provided you bilaterally negotiate the treaty and brought at par with MLA. See, this is a critical aspect. Any of the articles, if you look at in MLA, in majority of the cases, each of the articles from Article 3 to Article 20, you will see in place of, applies to or modifies to, in the absence of, or in place of, or in the absence of. So with regard to each of this, we call it as a compatibility clause. So how does it apply? In place of nothing but in general, what happens? There is something, some provision is there under the tax treaty. In place of that particular tax treaty, the MLI codified wordings is going to apply. But when does it apply? Both the countries have to choose to notify that particular provision. We will see in some examples which are all the provisions the treaty may get impacted, which are all the provisions the treaty may not get impacted. Applies to or modifies to. Applies to or modifies suggestion. There is something in the tax treaty with regard to this particular article. So therefore it goes and applies or modifies that particular aspect of the tax treaty. When does it apply? Both the parties have to notify. In the absence of, which means the existing tax treaty does not contain that particular provision. So therefore, MLA gives you a flexibility for you to replace that. Sorry, I should not use the word replace, rather include it, because it is not there in the tax treaty. You include it because it is not there. So when does it apply? All the treaty partner has to notify. Now, in place of or in the absence of, either there is a existing provision under the tax treaty or it does not under the tax treaty. So therefore, the wordings that are there in the MLI as part of each of the articles, wherever in place of or in absence of being there, either modifies the existing language. If there are no existing language, it gets added. But when does it happen? Both the parties notify, there is no issue. But if one of the parties notify, another is not notifying, can it supersedes? When it can supersedes? Those are some issues could come. We will see in some of the articles when this can supersede or when it cannot supersede. So if you look at, like I said, there are 104 countries as of 2nd October 2024. Lebanon has agreed to sign the MLI. If you look at from an India perspective, 93 out of 95 countries have been notified. China, Marshall Islands, and Iran is not being part of this because Iran, the treaty was signed much later than we notified the MLI as part of the ratification instruments. Switzerland, Germany, Mauritius, Oman. We have notified them as a cover tax agreement, but they never notified as a cover tax agreement. So therefore, with regard to these 4 countries, MLI will not get impacted. Now, out of this 93 tax treaties, 64 countries have already deposited their instrument of ratification. Out of the 64, 46 are alive. MLI is already applicable. Balance 18, if you look at, either they are in a provisional stage. Final instrument of ratification is not there. Within this 46, if I have to bucket it out, 28 countries in respect of which MLI is already effective from 1st April 2020. With regard to 2 jurisdictions, Sweden and Estonia, they have said that I have some internal procedures, like how do we have when we enter into a tax treaty. The tax treaty is entered, goes to the ministry approves it, then it is signed, then it is finally notified in the official gazette. After notification of the official gazette only, the treaty comes into force. Likewise, there are some internal procedures that they have to comply. So therefore, with regard to Sweden and Estonia, this is yet to be applicable. With regard to the balance 16, it is already applicable from 2021 or 2022 onwards. So out of 93, you come down to 64. From 64, 46 countries in respect of which MLA is already applicable. Now straight away jumping into some of the articles. Article 2 we talked about the interpretation of treaties, that is, when does a covered tax agreement, when it becomes a covered tax agreement. So normal interpretation of treaty, if you look at Article 3 gives you a definition. Article 3 of double taxation avoidance agreement give you a definition of certain terms. There are certain definitions there in the substantial provisions. Say for example, royalty or fees for technical services. Article 12 or 13 of the respective tax treaties defines what do you mean by royalty, what do you mean by FTS. If there are certain terms that are not there defined under the tax treaty, you go back to the domestic law. There is a divergent views across profession that should I go to the source country taxation domestic law, or should I go back to the resident country's domestic law if the terms are not defined. Predominantly the courts have swayed in and told that source country domestic law only you have to see if some of the terms are not defined under the tax treaty. Likewise, MLA has its own definitions. Now if some of the terms in respect of which MLA does not have any definitions, you can't straight away jump to source country domestic law. You have to go to the respective tax treaty to see whether that particular term is defined in the tax treaty or not. If it is already defined, then it is well and good. You take the treaty definitions. Only if the treaty has not defined a particular term, you go back to the domestic law. Article 3 talks about fiscally transparent entity, where India has reserved its rights. India said, I don't want to apply this article to any of the tax treaties, so therefore they reserved it. Just to show you how the reservation has been done. Now let me also take you through the wordings of the MLA. Para 5, if you look at, a party may reserve the right for the entirety of this article not to apply to this covered tax agreement. Then they are giving some flexibility. Why I am saying the document is so flexible is, you look at the kind of reservations do we have. For Para 1 not to apply to this covered tax agreement, that already contains the provisions described in Para 4. If your treaty already has a language as described in Para 1, then I don't have to look at. Let's look at what is the Para 1. For the purpose of covered tax agreement, income derived by or through an entity or an arrangement that is treated wholly or partly fiscally transparent under the laws of either of the contracting jurisdiction shall be considered to be an income of a resident of a contracting jurisdiction, but only to the extent that income is treated for the purpose of taxation by that contracting jurisdiction as the income of resident of that contracting jurisdiction. This is what the language it says. In simple, if I were to give it in the form of an example, India has a partnership firm concept where partner is assessed separately, firm is assessed separately. But in US or other European countries, the same partnership firm is treated as a pass-through, which means the firm will not be assessed for taxation. Whatever is the profit that are attributable to that firm will be assessed in the hands of partners. If the partners are resident of that particular jurisdiction, then I will see through that particular entity. Hey, look at, say for example, India is making a payment to a partnership firm of Netherlands. Now from an India perspective, partnership firm is a taxable entity. But from a Netherlands perspective, partnership firm is not entitled for taxation. The partners of Netherlands are subject to taxation. Now if I want to make a payment, I will be making payment only to the partnership firm in Netherlands. I will not make payment to the partners. There could be 3 or 4 partners. If assume for a moment I pay 1 crore as a consultancy fees to the firm, I will not look at what is the partnership ratio of these 4 partners and make a payment directly to the partners. All I do is I will make the payment to the firm. So therefore, if I were to look at the withholding tax incidence, now one of the conditions for me to invoke a tax treaty, I have to be a person recognized under a particular tax treaty. I have to be a resident of a particular tax treaty. And then I should hold a TRC as per section 90 subsection 4. Now 90 subsection 4 for a moment keep aside because that is a domestic law requirement. But from a treaty, I have to be a person. The person definition comes under Article 3. Then I have to be a resident, which comes under Article 4. Unless I fall under the definition of person, I can't test my residency. So therefore, to fall under person, I have to be a notified person. Now, under the domestic law of Netherlands, they are not a taxable entity. Firm is not being taxed. The partners are being taxed. So if you are not a taxable person, then the first requirement under the tax treaty that you are not a taxable person. But there are certain tax treaties, say for example India-US or India-UK, India-Canada, has these sort of propositions, similar to our trust law, where in case of a trust where the trustee's discretion is there, whether whatever accumulation that I have in the trust, it is at the discretion of trustee, the income may be passed on to the beneficiary. So likewise partnership, you take for a moment. So in this example, unless the partnership firm is a taxable person, they will not be entitled to benefits under India Netherlands. So therefore this particular clause is there to suggest if any of the person is fiscally transparent. In this example, partnership is transparent entity because it is not a taxable person in Netherlands. Then I will go and see who are the partners of this particular partnership firm. Partners, there are 4 partners from Netherlands. Now, these 4 partners are all resident of Netherlands. Yes, right? All the 4 are resident of Netherlands. If that is the case, then I can confer a tax benefit to the partnership firm. Because the word used is only or partly. Say for example, out of this 4, only 2 partners are resident of Netherlands, 2 are not resident of Netherlands. Then to the extent of 2 partners, I can confer India-Netherlands tax treaty. Now India has said, I don't want to apply this particular provision because for them, unless the treaty says you are entitled, if the treaty specifically provides for this looking through, then you are entitled for the tax benefit. If you are not, then you are not entitled for tax benefit. So therefore, this is the view of India. So therefore, they chose to reserve the right. How have they given their positions? Just to show you. To look at Article 3, with regard to each of this article, they have to give this. Pursuant to, if you notify, you have to notify that I want to opt for this particular clause, to which of the treaties in respect of which this clause will be applicable. Now you look at the reservation pursuant to Article 3(5)(a), 3(5)(a) of MLA Convention, 3(5)(a), Article 3, Sub-Article 5(a), for the entirety of this article not to apply. So therefore India doesn't want to apply this. So the moment I don't want to apply, now look at the para 6, which gives you a compatibility. Where all the, so I am reading from here. Where all the contracting jurisdictions have made such notification with respect to a provision of a CTA, that provision shall be replaced by. So therefore it requires all the contracting parties to notify. Only if both the contracting notifies, it gets replaced. So therefore, this is how I have to read each of the clause in the MLA. I have to see the position of India. Likewise, I have to see the position of other country. Here, the compatibility says replace. Both the contracting jurisdictions has to notify. Anyway, India is not notified. So therefore, question of MLI getting replaced does not arise. Now, Article 4 deals with dual resident entities. Typically, if you look at any of the tax treaty of Article 4, which talks about resident is further bifurcated into individuals and other than individuals. With regard to individuals, we always apply the respective domestic law. In India, you do have Article 6.1 read with 6.5 and 6.6 and 6A deemed residency based on number of days. Likewise, other country will also have number of days criteria to determine the residential status of a particular person. In case of if individual becomes a resident in both the countries, we apply. What do we apply? Tiebreaker. Each of the aspect of tiebreaker or factors we apply to decide which country is a resident. In case of corporates or in case of other than individuals, there are certain tax treaties which specifically provides how do you break a tie. Say for example, before 2016, India was looking at a concept of place of management for corporates. Now they have moved away from place of effective management for foreign companies. Likewise, India, other country may have different factors: place of incorporation, place of management, place where you keep the books of accounts. Those could be some of the factors. But how do I determine place of effective management? Now that we do have a specific CBDT guidelines, which was prescribed in 2016 and then 2017, where you will bifurcate the company between active versus passive business. Depending on active versus passive, you determine the place of effective management. Likewise, only in India and I think Belarus tax treaty, there is a protocol which categorically laid out the factors where those parameters that could be used for the purpose of determination of place of effective management. Now, India using place of effective management, other country is using place of management or place of incorporation as a test for determining residency of a company. Now there is a trouble. I am using effective management, other guy is using incorporation. Both are saying no, he is a resident of India, the other guy will say no, he is a resident of France. How do I resolve? There are existing some of the tax treaties which provides this could be resolved where through a place of effective management determination, which could be dealt by the competent authorities. Now, if you look at India tax treaties with across the 93 or 95 tax treaties, not all tax treaties has this particular clause where the place of effective management is used as a tool to have a tiebreaker in case of a corporate. So, Article 4 specifically bringing in this mechanism that in case of a person other than individual, the competent authorities can resolve the dual residency of these entities by applying a place of effective management. Say for example, in case of India, Japan, even existing tax treaty, keeping aside MLA for a moment, there is no tiebreaker concept for even individuals. India, Canada does not have a tiebreaker concept for corporates. There are certain tax treaties has it. So, by bringing this particular clause, I am enabling the companies to resolve the disputes. If not for this, there is no scope for some of the countries to challenge the dual residency, then they will end up suffering taxation in both the countries. Now what happens in a scenario where even competent authorities cannot resolve this tiebreaker? Then MLI provides, in case the competent authorities of the respective countries unable to resolve, then at their discretion they can give whatever relief or exemption they want to grant. Now if you look at the notification from India's side, first I will take you to MLA and then I will go to the respective notification. Now, where by any reason of provisions of CTA, a person other than individual is resident in more than one contracting jurisdiction, the competent authority of the contracting jurisdiction shall endeavour to determine by mutual agreement the contracting jurisdiction of which such person shall be deemed to be a resident. So therefore I am breaking the tie in favour of one country, having regard to its place of effective management, the place where it is incorporated or otherwise constituted, and any other factors. So I will apply any of the factors and break the tie. Now, in the absence of such agreement, such person shall not be entitled to any relief or exemption from the tax provided by the cover tax agreement, except to the extent and in such manner as may be agreed upon by the competent authorities. So therefore, you will not be entitled for any exemption. Say for example, you want to claim make available or a lower rate under the tax treaty. That exemption is not available if this dual residency is not resolved. But competent authorities may decide mutually and grant you some benefits. What benefits? It is at their discretion. Now look at the compatibility. Para 1 shall apply in place of or in absence of the provisions of CTA that provides rules for determining whether a person other than individual shall be treated as a resident of one of the contracting jurisdictions. Now para 3 talks about a party may reserve the right for entirety of this article to its CTA. For entirety of this article apply to CTA that already contains such clauses. Likewise, you do have a parameter. Now you look at clause E to replace the last sentence of para 1 with the following text for the purpose of its cover tax agreement. Now if you look at para 1 of this article, it says in case dual residency is not resolved, then to that extent and at the discretion of competent authority, whatever relief or exemption they want to give, they can give. Now, if I were to reserve the right under clause E, then what does it say? If you look at, in the absence of such agreement, such person shall not be entitled to any relief or exemption from the tax provided by the cover tax agreement, which means the moment I am not able to resolve the dual residency, you are not even entitled for any benefits under the tax treaty. So the discretion that are available to the competent authorities is being taken back by applying this part of a reservation. Now if I were to look at India's position with regard to this, now if you look at pursuant to Article 4.4, which mandates you to notify to which of the countries this particular article is applicable. India has notified the list of countries and where this particular article will get replaced. Now if you for a moment you look at Article Albania, Article 433 of the India-Albania Treaty. This 4.3 in the existing tax treaty, this MLI will get replaced. You look at, we have never made any reservations. We straight away went and made a notification. So therefore, from an India perspective, I will try to resolve dual residency by applying any of the factors. In case I could not resolve, my intent is if the competent authorities intend to give any relaxation, I will provide that relaxation. This is what the India's intent. Because the compatibility is in place of or in absence of, To the extent the other party has notified, to the extent there is a matching, that will apply. If there are any aspects which are not matching, then that becomes incompatible. That incompatible will not apply to the tax treaty. Now, if you look at India, Japan, or India, Australia, they have reserved the right with regard to Article 3, subarticle para E, wherein the discretion that is available to the competent tax authorities has been taken away. So therefore, with regard to India, Japan, India, Australia, I can resolve dual resident entities by applying MAP. If they are not able to resolve this, then the competent authorities cannot grant relief at their discretion. Whereas with regard to other treaties, they can grant. With regard to Japan or Australia, they cannot grant it because Australia and Japan has reserved the right of competent authority to grant some of the exemptions. This we have to link it with Article 16 as well, because Article 16 talks about dispute resolution with regard to mutual agreement procedure. In case of any dispute with regard to a tax treaty, there are two ways to do the dispute. One, I can file a normal appeal, go to the CAT appeal or a DRP route, go to the tribunal, High Court, Supreme Court. Alternatively, treaty also provides you a mechanism whereby you apply, make an application to the competent authorities and then resolve the dispute through the competent authorities. So wherever competent authorities are involved, that has to be done through a mutual agreement procedure, which Article 16 we have to look at. Methods of elimination of double taxation, our foreign tax credit related article. There are three options that the MLI has suggested. Why there is a need for three options? Because across 106 countries, there are various methods by which they are giving a tax credit, or double taxation is rather avoided. One, they can exempt you from a double taxation. You have taxed in one country, I don't want to tax the same income in another country. Or the other country may choose to give a deduction. The third option could be exemption. Whatever income that you have taxed there, you choose not to tax it. So therefore option A is nothing but wherever there is an exemption method, you switch over from exemption method to a credit method. Exemption method, option B is exemption method cannot be applied for specific streams of income. Say for example, interest on CCDs. India treat this as a deduction, whereas there are certain European countries where interest on CCD is treated at par with dividend. So the moment there is a dividend, they may not choose to tax that particular dividend based on participating exemption. So therefore these sort of exemption mechanism they want to avoid. Then the third, majority of our tax treaties we follow credit mechanism. To the extent of double taxation, I anyway relieve you from double taxation by allowing you a credit. India has chosen to apply option C. Now, if the other treaty partner has chosen option D, then if I am dealing the treaty with regard to Indian residents, option C will apply. The other country will continue to apply option B. So here it is a case where the compatibility of options is not important. So not that both the countries have to choose the same option for you to apply. For the respective residents, whatever the options you have chosen, you apply that. India has chosen to apply option C, which is a credit method. With regard to his residents, he will apply only option C. If Singapore wants to apply an exemption-based methodology, he can apply exemption-based methodology with regard to their residents. Because the purpose of foreign tax credit is what? Who is the right to give a credit for foreign taxes. It is the resident country which is going to give. So therefore it is a choice of the respective resident entities where you will apply this. Now coming to Article 6, which deals with preamble to tax treaty. If you look at all the tax treaties has its own preamble. It could be for elimination of double taxes, or it could be for economic improvement of cooperation or collection of taxes. Several head note will be there with regard to each of the tax treaty. Now, MLI tries to bring a particular article language which says that a treaty intending to eliminate double taxation, which is predominantly there in any of the articles, with respect to taxes covered by this agreement, without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, then within brackets, including through treaty shopping arrangements aimed at obtaining relief provided in this agreement for the indirect benefit of residents of third jurisdiction. They have also given some additional language desiring to further develop economic relationship and to enhance their cooperation in tax matters. Now this Article 6, if you look at it, is a minimum standard with no leeway. Irrespective of whether you want to apply or not, it doesn't matter. It is mandated. Whether you want to opt for opting in or make a reservation, there is no possibility of such. You have to include this particular language as part of your tax treaty. Now, if you look at India's position, we remained silent. Other counterpart has opted for it. What will happen? It doesn't matter whether you notify or you not notify. It is a minimum standard, de minimis you have to apply. So therefore, irrespective of India remaining silent or not, it doesn't matter. This particular language gets added to the tax treaty. Impact of additional language, it is an option. India has remained silent. If the other party is wanted to opt for this particular language, there is no inconsistency, this additional language gets added. Now you look at the impact of a covered tax agreement. Singapore, France, Netherlands, key treaties where this preamble gets modified. India, Hong Kong, DTAA, which got amended or rather bilaterally negotiated in 2018, already has this language. So to the extent there is an incompatibility, it will not get added. Wherever there is an incompatibility, it will get added. Now what happens as a result of it? How do I interpret the preamble? What is the significance of a preamble? Now if you look at the language, without creating opportunities for non-taxation or a reduced taxation through tax evasion or tax avoidance. Tax evasion, everyone is very clear, it is illegal. What about tax avoidance? To what extent tax avoidance is acceptable? There is a plethora of decisions right from Westminster Principles case till to the date of recent Tiger Global decision. So much of water has flown down with regard to what constitutes tax planning, what constitutes tax avoidance, to what extent tax avoidance is acceptable. Then another aspect is treaty shopping. I shop a treaty. Say for example, US entity investing in India. After 10 years, they want to sell the shares of the Indian entity. If they sell the shares, they are subject to capital gains. As per India-US tax treaty, India has a right of taxation. Now, if US were to structure this transaction, saying before 2017, they have incorporated a Mauritius or a Singapore company and routed their structured investments through Mauritius. US entity investing in Mauritius and then Mauritius investing in India. if Mauritius were to sell the Indian investments that are acquired before March 2017, the right of taxation of capital gains is with Mauritius. Mauritius does not levy any capital gains tax in their local domestic law. So therefore, had I invest directly, I have been subject to some taxation, which I am avoiding by doing a treaty shopping. So these sort of structures, they want to avoid. So therefore now preamble is coming and saying that the purpose of treaty is to eliminate double taxation, but not at the cost of non-taxation or a reduced taxation or favoring some other third persons who are not resident of the other country. In this case, who is getting benefited? The example which I gave. US company is getting benefited. Why? By investing it through Mauritius or Singapore. So therefore, to avoid all these things, they brought in this particular preamble to the tax treaty. Now even our section 90, where the powers are given to the central government to enter into the taxation, where earlier, before MLA comes into picture, the purpose of entering into tax treaty with the other country is only to eliminate double taxation. Now they brought in similar to preamble of the tax treaty, whatever is envisaged in Article 6 is there in 90 subsection 1b. Now how do I interpret the preamble? It has to be interpreted, whatever is the cover tax agreement has to be interpreted in light of a preamble. Now if you look at action plan 6, which is the base document for them to bring this preamble, they are given that the intent of the tax treaties is envisaged through preamble. So to the extent the preamble is important when I interpret each of the provisions of tax treaty. So if I were to interpret a capital gains clause, I have to interpret with the preamble as well. Do I give in something which is not otherwise allowable? This aspect of preamble of tax treaty was a subject matter of debate before the Supreme Court in Azadi Bacho Andolan, the famous ruling in the context of India-Mauritius tax treaty, where they relied on the language of the preamble, which says encouragement of mutual trade and investments. So the purpose of investments from Mauritius into India is to encourage mutual trade and investments. India, where at that stage requires foreign investments, so therefore they felt treaty shopping is to some extent is acceptable. There was a circular which was issued by the CBDT in the context of India-Mauritius, Circular 789 of 2000, wherein they have said a tax residency certificate which has received from a Mauritius tax authorities is sufficient to prove your residential status and is enough to claim a tax benefit under the treaty. This was the subject matter of challenge before the Delhi High Court. The Delhi High Court quashed the circular stating that this is not constitutionally valid. Then the Union of India filed an appeal against the Delhi High Court, and then they got the ruling in the favor that the circular is valid. Now as a part of that ruling, they have observed that you look at the preamble of India-Mauritius Treaty, which says encouragement of mutual trade and investments. Now, if the same Asati Bacho Andolan has to be revisited in light of the upcoming preamble, how does it reflect? All the structures that I have put through, where some other benefit is being conferred upon some third country, whether MLA will grant you such benefits, is a question one has to ponder upon. So therefore, if you look at even Mauritius, the recent protocol, which is pending to be notified, has similar preamble. Now what will happen to the latest structures? that are yet to be sold. Those things are very critical. In fact, one aspect we have to look at is impact of the amendment of the preamble on grandfathered investments. What do I mean by grandfathered investments? Say for example, India, Singapore or India, Mauritius. In 2016, there was an amendment that are carried out in India, Singapore and India, Mauritius. Either to, if the Singapore company were to invest in India and if they were to generate capital gains, the right of taxation is always with the country where the alienator is resident. Invariably, Singapore companies or Mauritius companies were selling the shares of the Indian company and they were claiming that by virtue of tax treaty, this particular income in the form of capital gains is not taxable because treaty supremacy. Now, after this protocol that was entered in 2016, it was bifurcated into three segments. One, if your investments are made before 31st March 2016, but you are transferring the shares after that, whatever investments that are made before 31st March, on or before 31st March 2016, the country where seller is resident, that country only will have a right of taxation. Now, any investments that are made between a transition date, 1st April 2016 to 31st March 2018, then India will have a right of taxation. I am more looking at from an inbound investments. Singapore entity or Mauritius entity investing into India. If the investments were before 31st March 2016, then India does not have a right of taxation. Only Singapore or Mauritius will have a right of taxation. But if the investments were in between 1st April 2016 to 31st March 2018, then India will have a right of taxation, but at a 50% of the rate that are applicable. Anyway, these are all short terms. So short term at that point 20%, 50% of the rate is 10% is what India can tax it. In case of a foreign company, if the short term rate is 40%, then 20% is the rate at which I will tax them. 50% of the normal rate. But any investments after this cutoff date, India will have a right of taxation in addition to the resident country, which means from Singapore to Mauritius, I have transitioned, I have got the right of taxation. But what happens to those grandfathered investments that are invested into India before 31st March 2016? It is only the respective countries will have a right of taxation, which is not India. Now, by bringing this preamble, wherein it says taxes covered by this agreement, double taxation has to be avoided without creating opportunities for non-taxation. What happens here? India does not have a right to tax. Neither Singapore nor Mauritius levy any capital gains tax. Singapore now recently they brought some amendments, but that is applicable in a limited fashion with regard to capital gains. 10L. That is limited fashion. So there is an opportunity for non-taxation or a reduced taxation, including through treaty shopping arrangements. So if the investments are made by the Singapore residents, you don't have a problem because there is no treaty shopping. If the individual directly make investments into India or the through a corporate firm, it doesn't matter. Only Singapore has a right of taxation. But imagine a third country person, resident, in the example I gave, US, there to invest, then you do have a trouble. So what happens to the grandfather investments will be a question one has to ponder on. Whether I will still be entitled to grandfathering or at treaty preamble or the Article 7 which we are going to discuss will come and hit you with regard to this. Principal purpose test. This is a glorified form of a general anti-avoidance rules. We do have a GAR. Before that, we have selective special anti-avoidance provisions. You do have a transfer pricing provisions. Section 48 to be payments made to a related person, whether it is within the fair market value or not. There are certain SARs that are already available. Certain tax treaties have limitation of benefits clause. Say in 2016, when India entered into a tax treaty with Singapore or Mauritius, we do brought in limitation of benefits. But there are difference between India-Singapore vis-a-vis India-Mauritius treaty. Now, what they say is, it is a minimum standard. It shall be part of your cover tax agreement. They have given you options. Option A, you adopt principal purpose test. We will look at what does the PPT means. Second, you adopt principal purpose test coupled with simplified LOB, limitation of benefits in a simplified form. And third is bilaterally negotiate with the country, bring a limitation of benefits at par with Article 7 or much severe than Article 7. Now what India has adopted is, I want to go with an option of LOB, rather PPT plus SLOB, simplified limitation of benefits, coupled with principal purpose test is what we want to adopt as an interim measure. To give a corollary, Mauritius, if you look at, they never opted PPT. They never opted PPT plus SLOB. Rather, what they said is, no, I will bilaterally negotiate with my counterparts and try to bring in some provisions which is equivalent of Article 7 or much severe than Article 7. As a result of which, we had this recent protocol where they brought in principal purpose test as part of India-Mauritius tax treaty, which is yet to be notified. So this is how this particular clause works. Now what does this clause try to say? Similar to our general anti-avoidance. In general anti-avoidance, what does it say? If a tax benefit is more than 3 crores and the main purpose of an arrangement is to obtain a tax benefit, then I can treat this particular arrangement as an impermissible avoidance agreement. They have given you some parameters as to what do you mean by impermissible avoidance agreement. Likewise, treaty says, it is more from a treaty language perspective, notwithstanding any provisions of the covered tax agreement. Any provisions means from Article 3 to Article 29 onwards, up to 29, or certain treaties are 30, 31 as well. Notwithstanding any provisions of the covered tax agreement, a benefit under the covered tax agreement shall not be granted in respect of an item, of an income or capital, if it is reasonable to conclude, having regard to all facts and circumstances, that obtaining the benefit was one of the principal purpose of any arrangement or a transaction that resulted in directly or indirectly in that benefit. So therefore they say a benefit conferred upon a particular person under a particular clause of a tax duty should be denied if it is based on the facts and circumstances. A reasonable conclusion can be drawn that obtaining the benefit was one of the principal purpose, whereas if you look at GAR, it says main purpose, whereas here it uses the word one of the principal purpose. So therefore, in a transaction anyway, incidental or one of the purpose could inevitably a tax. So therefore, how do I prove that my main purpose of entering into a transaction or an arrangement is not for the benefit of tax duty? So therefore, the burden is on the taxpayer to prove. If the tax authorities have a reasonable conclusion based on all facts and circumstances, hey, look at the purpose of you entering into the transaction is to take this benefit, which is otherwise I see not available to you, then I have to prove that one of the principal purpose is not to have a tax benefit, or there is an object and purpose test. Unless the taxpayer establish that granting that benefit in these circumstances would be in accordance with object and purpose. So in the earlier aspect which we were discussing, the grandfathered investments, can I go and argue that the tax treaty between India and Singapore was entered in 2016, the amended protocol. At that time, MLI was available. The action plan 15, action plan 6, everything was available. Despite having all these documents, both the countries have bilaterally negotiated that I will grandfather these investments. The right of taxation, I will maintain a status quo. But with regard to those investments that are entered, I will give a right of taxation to source country. So therefore, this purpose of grandfathering, can I argue, it is the object and purpose of the relevant provisions of tax treaty. This is one interpretation one has to look at. Now what happens? What is the effect of PPT? It overrides all other provisions of tax treaty. Similar to our GAR, it is overall because it uses the word notwithstanding any provisions of the covered tax agreement. But what does it try to avoid? Only benefits under the convention. If you are taking any benefits under the domestic law, then principal purpose test will not be bothered about it. Only those benefits, it could be on account of lower tax, lower scope, non-taxation, anything. It applies to transaction by transaction, not to one entity. So this could give rise to a situation where a particular entity, say in the same example, US, I will take US, let's say Singapore and India. The investments is structured may need to take the benefit of capital gains between India and Singapore. Assume for a moment there is a capital gains arising. There is a grandfathering provision, so you want to argue. Now, if this particular structure is tainted, saying it is a conduit, PPT will come and say capital gains benefit should not be given to this particular transaction. At the same time, there will be dividend that is paid from India to Singapore. Whether the color of this transaction, the structure which you put through for capital gains, can equally apply even for dividend. If you look at the language, it says in respect of an item of income or a capital with regard to an arrangement or a transaction. So therefore, an item of an income. So each income stream I have to look at whether this particular transaction or an arrangement is satisfying the requirement of the principal purpose test. So therefore it is a transaction or an arrangement specific rather than entities. If entity could be a colorable device, but for that particular transaction, is it colorable device? Should I look at it in this fashion, or should I say no? If it is a shady for one stream of income, it is shady for all stream of income. This is one interesting aspect one has to look at. Arrangement or transaction. What do you mean by arrangement or transaction? GAR 102 of the Income Tax Act provides the definition of arrangement or transactions. Your 92F defines arrangement. So therefore, it includes series of transactions or series of arrangement. So therefore, just because I break the arrangements into parts, doesn't mean that I can't see through the transaction. It can be seen through. Benefit could be direct or indirect. It can have a retroactive application. Unlike GAR, where there is a grandfathering, which comes under Rule 10U, whereas here even the past structures can be put under the lens of principal purpose test. Although powers under PPT is limited compared to what is there in GAR, because GAR you can recharacterize a transaction, recharacterize a capital expenditure into revenue, a capital receipt into a revenue receipt. Likewise, such recharacterization is not possible under PPT. It simply says treaty benefit has to be denied. But at the same time, you look at GAR, we do have several procedures that has to be followed. First, a show cause notice has to be issued by assessing officer with the approval of commissioner. Then commissioner will give you an opportunity. Then after that, they will refer to the GAR panel. GAR panel then declare whether an arrangement is impermissible or not. But there is no such mechanism under PPT. So therefore, from a treaty perspective, this is a much more better weapon in the hands of assessing officer compared to what is there in the GAR. One point with regard to SLOB is similar to India-US treaty, where you do have a limitation of benefits clause. Limitation of benefits is a qualifying conditions for you to entitle to a tax treaty. Likewise, SLOB has several parameters, 4 layers of parameters for you to satisfy. First, if you are a qualified person, you are entitled to tax treaty. What do you mean by qualified person is already been defined. Now, second, if you are not satisfying qualified definition, but if you are an entity which is owned by qualified persons, then you are still entitled for tax treaty. If you don't satisfy these two conditions, then the third condition is active business test. Are you satisfying this? If you don't satisfy even this, then equivalent beneficiary is one concept they are trying to bring in. If you don't satisfy all the 4, then I will leave it to the competent authority where you can justify and take a benefit. But they don't have any such discretionary benefit. Similar Article 7(1) which says a treaty benefit can be denied. There is a specific provision, Article 7(4). There it provides discretionary relief, similar to what we saw in Article 4. Dual resident entities, competent authorities can give you a discretionary relief. Likewise, in Article 7 also there is a provision for discretionary relief. However, India has not opted for that particular discretionary relief. They said if you are entitled, you prove it. If you are not entitled, you are not entitled. I don't want to give you any discretion at all. That is what Article 7, and we do have some examples there as part of the tax treaty. This case study which I have already discussed more in the context of grandfathering of investments. That from a Singapore perspective, if some of the investments are entered before 2017, applying the grandfathering provisions, where India says that I don't want to tax those investments which are invested before 2016, 31st March on or before, I don't want to tax it. Can that falls under the object and purpose for me to get away from principal purpose? Just the essence of this case study. Simplified LOB, like I said, qualified person, active business. Derivative benefit rule is nothing but the equivalent beneficiary. If I come directly, will I be entitled for this deduction instead of indirectly? If the benefit under direct versus indirect remains the same, to put it in the form of an example, Netherlands entity, Singapore entity, then investment in India. I make a payment in the nature of fees for technical services to Singapore entity. Singapore entity in turn pays to Netherlands. Now, India-Singapore treaty, there is a make available provision. By applying the make available, I am saying this particular payment is not subject to a withholding. Now, if one were to apply this logic, SLOB that hey, you have come to a treaty shopping, you have come in such a situation where this transaction is not subject to taxation. Now, under SLOB you can go and compare, okay, whether the benefits that are conferred on India or Singapore is equally applicable for India and Netherlands. India and Netherlands also has a make available clause. If I have come directly, I am entitled for make available. How does it make a difference if I come indirectly? Anyway, I am entitled for that exemption. So therefore, equivalent beneficiary will come in this sort of a fashion. Same with regard to rate. If rate under the tax treaty remains 10%, then there is no way one will come through a different structure. Anyway, I am entitled for it. What will I achieve by coming indirectly? Those sort of aspect is what looked at as a part of equivalent beneficiary, which is derivative benefits only. But the only aspect we have to look at is there are only 14 odd countries which has opted for SLOB, including India. So only those 14 odd countries in respect of which you have to apply principal purpose test and SLOB. One interesting nuance is with regard to India and Greece, where India want to apply principal purpose test and SLOB for the purpose of treaty applicability, entitlement to the benefits under the treaty. Whereas when Greece wants to apply to Indian residents, they will apply only principal purpose test. So SLOB will apply asymmetric. India alone will apply, whereas Greece will not apply. With regard to the other countries which have not opted for SLOB, you have to apply only principal purpose test. See, this dividend transfer is a one situation where there are certain tax treaties. We have 93, out of which close to 26 or 29 tax treaties only. With regard to this dividend article, we have some peculiar wordings. Take example India-Singapore itself. Why I am taking India-Singapore is because both the countries has this peculiar language. Likewise, India-Mauritius has, India-US has, UK has. US is never part of MLA, so therefore no point in looking at their treaty. Now, under the dividend article, you do have 2 or 3 types of rates. There is some case where if the investments are made by certain notified government entities, then dividend may be exempted. Then second is a situation where if you are holding in an Indian company exceeds a particular threshold, say for example more than 25%, then you are subject to a taxation at the rate of 10%. If your holding is less than 25%, then the rate of taxation is 15%. So therefore, depending on your shareholding, there is a different rates that are being applied. So only 26 to 29 odd countries only in respect of which this classification based on shareholding is applicable. Wherever there is a threshold of holding percentage is given, in respect of those countries, DTAA, what does the Article 8 says is, as on the date of payment of dividend, I have to look at whether are you holding this investments for a period 365 days. If your holding is to the extent of 365 days, then you are entitled for a lower rate as prescribed under the treaty. Otherwise, you are not. Why? Because many times what happens just before declaration of dividend, people tend to move their taxation structure from one country to another so that you get the benefit of lower taxation or a nil taxation. So to avoid these sort of structuring, which is more prevalent in the European side, because the transaction of transfer of shares may not be subject to capital gains, whereas in India you do have the moment you do a transfer, there is a capital gains incidence. So India has opted for this particular article where, except for Portugal, all other 24 countries in respect of which they want to apply this article. So therefore, I have to look at the holding percentage and 365 days. So therefore, whenever there is a dividend that has been declared, if that is subject matter of a withholding, then I have to look at whether Article 8 applies to that particular tax treaty or not, whether the other counterpart has also notified this or not. If that is the case, then 365 conditions has to be looked at. Then only they are entitled for lower rate as per the tax treaty. Otherwise, they will not be entitled for this lower tax rate. They will be subject to 20% taxation. Why they want to leave India, Portugal is because the existing tax treaty says 24 months holding period. Because my existing treaty is much more severe compared to what it was envisaged in MLA, so therefore this particular relaxation may not apply there. One issue could come with regard to what if 365 days is satisfied subsequent to payment of dividend. There is no guidance that are available under the India tax authorities, but Australian tax authorities have issued a guidance that if the 365 days is satisfied after the payment of dividend, then let the recipient of dividend file a return of income and take a refund. So from a payer perspective, I will still do a higher withholding. Let him say, I have satisfied the 365 days and apply the treaty rate and take a refund. Whether that particular guidance could be applied from an Indian context, one has to wait and see. So this is with regard to capital gains derived from immovable property. It's a case Article 9. One interesting aspect that we generally look at is capital gains from the transfer of shares. Generally taxable under the domestic law. There are certain tax treaties where, like I said, India, Singapore or India, Mauritius, you want to give away the right of taxation to other countries. But what happens in a scenario where the investments are made in a real estate companies? So if I were to sell the land will be sold by the Indian entities or the Indian companies in which the land is located. So therefore that portion of transfer is anyway be taxable. To avoid this, so to avoid this, what companies were to do, instead of selling the land, they'll sell the shares. So thereby they take the benefit of the tax treaty. Now what happens? This is one layer. There is an Indian company holding a land. Now on top of Indian company there is an investments from, let's say, Japan. Above Japan, there is one another Japan. So in this case, example which I have given is French company 1, French company 2, there is an Indian company. Indian company holds immovable property. In this case, IP refers to immovable property. Now what happens? If the Indian company were to sell the shares of, sell the immovable property, then Indian company is liable to taxation. If the French company were to sell the Indian company shares, because it is a 100% holding company, India has a right of taxation. Now imagine if French company 1 were to sell the shares of the French company 2, India company may not have a right of taxation unless I invoke indirect transfer provisions under the domestic law. Assume for a moment indirect transfer provisions is triggered. The value of French company 2 is derived from the value of Indian company. Indirect transfer is triggered. But under the treaty, there has to be an indirect transfer provisions for me to give a right of taxation. Normally from a shares, hardly any treaties which gives you a right. But there are specific articles which deals with immovable property under capital gains article. If the example could be is, show one treaty. as per India-France treaty. Now you look at subclass 4. Gains from elimination of shares of the capital stock of a company, the property of which consists directly or indirectly, principally of immovable property situated in a contracting state, may be taxed in the contracting state. For the purpose of provision, immovable property pertaining to industrial or commercial operations of such company shall not be taken into account. This second sentence is peculiar to France. Otherwise, some of the tax treaties has this language. If the value of overseas company, in our example French company 2, is represented by the immovable property situated in India. Indian company derives its value from immovable property. In turn, French company 2 derives value from immovable property. So therefore, if this is the case, then the country where the immovable property is situated, despite the shares that are being sold as French Code 2, India will have a rate of taxation. Because the value of French Code company derives substantially from the immovable property that are located in India. Similar to an indirect transfer. In indirect transfer, you are looking at the value of shares. Here it's your value of immovable property that being generated. So the only difference between the Income Tax Act under the tax treaty is with regard to indirect transfer provision in this case, in the context of immovable property. Under the indirect transfer regulations, the word substantially has been used in explanation 5, which got expounded in explanation 6, which says 50% at least the value of the foreign company should derive from India. Here the word used is principally in the tax treaty. What do I mean by principally? There are only select treaties. Say for example, India Israel defines you what do you mean by principally. They say 50%. India-Korea treaty, because these two treaties were negotiated after MLA, this particular clauses. So therefore they are able to explain. 50% is the threshold which was clarified in Article 8. They also have a condition of 365 days holding prior to the date of transfer. So this value of 50% will be looked at prior to the date of transfer for a period of 365 days. Why I have to look at 365 days prior? There could be a situation where this might have derived substantial value at a point in time, but because of this indirect transfer exposure, I may artificially inflate some other assets into the company, thereby at the time of transfer I can reduce the threshold of 50%. So therefore, to avoid this, they are looking at a look back provision. I will not only look at this 50% at the time of transfer, 365 days prior, I will look at it. This is what it has been trying to address. Now one small issue which will come with regard to this is the exception which I have read now as a part of France treaty. For this purpose of this provision, immovable property pertaining to industrial or commercial operations of such company shall not be taken into account. Whether this exception after MLA provisions comes into picture will be available or not is a point of dispute which will emerge in the future. The normal indirect transfers. So if you look at the treaty as such, the treaty in the context of capital gain is subdivided into several categories. The category 1 talks about alienation of immovable property referred to in Article 6. So Article 6 of each of the tax treaty generally will define you what do you mean by immovable property. Then this particular immove property is dealt under. So if I am directly selling immove property, my clause 1 will cover. Clause 2 will generally deals with immove property owned by permanent establishment. Clause 3, if you look at it, is dealt by ships or aircraft operating in international traffic or moved property. Fourth is talking about immove property. Although what you sell is the shares, but if the share is derived value from immove property, Article 4 will apply. If the shares does not derive any immove property value significantly from immove property, then Article 4 may not apply. So let's say for example, if the value derived from immove property is 30%, then clause 4 may not apply, clause 5 will apply. Clause 5, if you look at gains from alienation of shares other than those mentioned in para 4, representing a participation interest of at least 10% in a company which is a resident of a contracting state may be taxed in that state. So therefore there has to be de minimis participation 10% is required for you to trigger taxation. If my taxation in India, let's say if my holding in India from a French company is only 9%, then right of taxation is only with France. But if my participation is 100%, but what I sell is only 5%, can I argue that okay, my sale is only 5%, so therefore it is less than 10%? The answer is no. Because what does it says is, the participation in a company is de minimis 10%. How much of shares you are diluting is irrelevant. If your participation is more than 10%, then you are subject to taxation. Now in this regard, there is a question that whether indirect transfer is covered under this particular clause or not. Assume for a moment, if the value is significantly deriving from immove property located in India, clause 4 will apply. If the value is less than 50%, clause 4 will not apply. Indian indirect transfer will not apply because there also it requires 50%. Assume for a moment the value derived from the Indian assets is not immove property. It's a service company, but it has potential value. Then 50% threshold could possibly met under domestic law. 911 may trigger, read with Vodafone amendments. Explanation 5, 6, 7. Right of taxation may trigger under the domestic law. But under the treaty, whether this indirect transfer is taxable or not, if you look at the wordings of the treaty, alienation of shares other than those mentioned in para 4, representing participation even if it is 100% held in a company which is a resident of contracting state may be taxed. So therefore, whether the shares that are in this example, assume for a moment it is not immove property, it is normal. What has been sold is French company too. Where is it located? It is located in France. So therefore, may be taxed only be in France. Although there is an indirect transfer provision there under the domestic law, but not in every case treaty supports it. So despite there is a domestic law provisions, you can't read that particular domestic law into the tax treaty. You can't superimpose it. So by virtue of this, to answer your question, the normal indirect transfer may not get taxed here, but if it is where significantly deriving value from a immove property which is more than 50%, it may get caught under Article 4, sub-Article 4. There is a one difference between Article 8 and Article 9. Both the articles talks about 365 days. The only difference is, in this particular article, it categorically says 365 days prior to the date of transfer. Whereas in Article 8, the dividend transfer exemption, it only talks about on the date of payment of dividend, I have to satisfy 365 days. It never categorically says I should look back or look forward. So that is the difference between this article and that. That doesn't mean that Article 9 look back provisions I can borrow it for Article 8. Each has to be looked at separately. Article 12, if you look at avoidance of agency fee, see, the purpose of this particular article came mainly from European countries, where there is a commissioner model that is much more prevalent in a common law country as compared to a civil law countries. Where in India there is a normal contract acts applicable, agency is being defined, I act on behalf of. Whereas in a commissioner model, I enter into a contract with the customers, but the satisfaction of that contract, the service to that contract, either in the form of rendering service or delivery of goods, will be done by someone. In case of agency, it is not possible. I can't enter into contract in my own name. I act on behalf of principal. But whatever conditions or terms which I enter, that binds the principles. That is a principle in which. So what happens in this sort of commissioner arrangement is, to some extent this is applicable even for an agency as well. Either to any of the tax treaties, if you look at, for example, I will take India, France itself as an example because I have it handy. Article 5. Generally, para 5 talks about the agency provisions, right? Notwithstanding the provisions of para 1 and para 2. Para 1 defines what does a permanent establishment. Para 2 gives you an example of permanent establishment. Branch, warehouse, factory, all these are examples that are given. Article 3 or Article 4 will give me preparatory or auxiliary exemptions despite there is a fixed place PV. If these are all restricted activities I perform, still you doing it through a fixed place of business, this may not be tantamount to a PE because these are all preparatory or auxiliary. We will look at that. What does the MLI try to address with regard to Article 13 read with Treaty 5.4. Now looking at para 5, in this case, deals with agency, where a person other than the agent of independent status. So therefore, someone who is not an independent agent, a dependent agent, to whom para 6 applies. Independent status is defined in article, para 6. If I am not satisfying para 6, then I may become a dependent agent, provided he has and habitually exercise in a contracting state and authority to conclude contracts on behalf of enterprise, unless his activities are limited to purchase of goods or merchandise for the enterprise, or he does not have an authority but maintains in the first mentioned contracting state a stock of goods or merchandise from which he regularly delivers goods or merchandise on behalf of the enterprise. So either I have an authority and I exercise that authority by concluding a contract on behalf of the principal, unless my activities are confined to purchase of goods or merchandise. Why purchase of goods or merchandise they want to exempt us? If you look at preparatory or auxiliary, the third item, or rather fourth item, maintenance of fixed place of business solely for the purpose of purchasing goods or merchandise or collecting information for the enterprise. If as a France resident, I have a place of fixed establishment in India through which if I purchase goods, that activity is anyway exempt. If I directly do this activity, I am being exempted. What difference it makes if I engage someone else to do this activity? So therefore they want to give this relaxation even in case of an agent if his activity is confined to purchase of goods or merchandise. Second aspect is, I don't have any authority, but I maintain the stocks of the French entity through which I deliver. Say for example, warehouse. I keep the stock of the products manufactured by French company. From there I keep on delivering the goods. If these two aspects I perform, then I can be regarded as a dependent agent. In section 9, when they defined the business connection in 2003, they have defined business connection in an inclusive manner, which has similar clause. In addition to that, securing of orders were also included as a part of section 9. Now there are instances where conclusion of contracts. What do you mean by concluding of contracts? There are occasions where people negotiating the terms, but the signing of contract is done by the principal. So therefore they went on to argue that I never concluded contract, I only negotiated, that fellow has only finally signed it. So therefore they were trying to argue that a conclusion has not happened, despite you conduct all the activities in substance, except for signing of the forms. But from an Indian jurisprudence, if you look at, they always looked at substance, that if you have negotiated everything and merely the signing of contract is by the principal, doesn't mean that you have not played the agency role, you will still be regarded as a dependent agent. Now because of this commissioner model in the Europe, they want to address this situation, where what they have said is, there are occasions where agents have concluded contracts without any modifications. The principal has accepted the terms and conditions. More in the case of a digital contracts, what will happen? I go to the customers, I explain them the terms and conditions, whatever is the product range available, price available, everything, except for the fact that he goes to the website, place order and accept them. So therefore these sort of instances were happening. So therefore to avoid all this, an extended agency definition was put in place. If the principal were to accept the terms of the contract, where the agents routinely conclude, and this routine conclusion of contracts were accepted by the principal without any material modifications, then the role played by the agent is regarded as a dependent agent. This is one aspect they want to extend. So thereby there is no way that the agent can argue I am an independent agent or I never concluded the contracts. So therefore now you have a different limbs. One, you have an authority. With that authority, you conclude the contracts habitually. Second is, you are engaged in such a manner that the conclusion of contracts happens elsewhere, but without material modifications. So I will read you the language of Article 2 of Article 12 of the MLA. So, notwithstanding the provisions of CTA that define the term permanent establishment, but subject to para 2, where a person is acting in a contracting jurisdiction to a covered tax agreement on behalf of the enterprise and is doing so, habitually conclude contracts or habitually playing a principal role leading to conclusion of contract. So therefore I have to play a dominant role which led to a conclusion of contract that are routinely concluded without material modifications. So whether the role of the agent is its principal role, if so, then whether the principal that are located in some other country, is he accepting the contract without any material modifications of the terms or conditions? If that is so, then the role played by the agent is a dependent agent. So either to what if you look at France DTAA, exercise a contract and authority to conclude contracts on behalf of. Now if France were to accept this provision, how it will get modified? It will be modified in this fashion. Habitually conclude contracts or habitually place principal role leading to conclusion of contract that are routinely concluded without material modification. So an extended agency will get captured in the treaty. Whether or not the contract in the name of enterprise or for transfer of ownership or granting the right to use property owned by the enterprise or the enterprise has the right to use, or for the provision of. So this is where in the name of enterprise is where the commissioner arrangement comes in, which is not relevant in India, but nevertheless we borrowed this because many occasions where the agents plays a dominant role. The moment they play a dominant role, if they are not falling under the exceptions in the case of independent agent, then they will get caught under the extended definition of agency. This is what Article 12 is trying to address. Now the example I gave is you do have a foreign company which sells goods to customers in India. Sub-company enters into a contract. They solicit and receive contracts, enters into a discussion. But contracts are concluded by foreign company. The terms and conditions that are given in the agreement cannot be modified by the sub-company. Based on the standard terms and the price range that was quoted, based on that I have to go and enter into a discussion with the customers. Whatever contracts that I have got, I have sent it to my parent company. The parent company may feel free to accept or reject it. In this fact pattern, if I were to interpose this extended agency function, what are all the factors that could play an important role? One, there is a standard terms. I don't have any authority to modify the standard terms. If at all the client asks for some modifications, I don't have an authority, I have to go back to the parent. This is one way of looking at it. Alternate way of looking at this, I convince the customers to the standard terms. In case of software licenses, do we have any choice in modifying the terms and conditions? No, we just accept and agree. So that is how the standard terms contracts are working. So there is a price range that has been given. Within this price range, I can operate. So I have a liberty to give discount to the customers within the price range. Whether this could lead to a situation of conclusion of contract, some of these aspects are important to consider. So the standard terms, enabling the customers to agree to your standard terms, could also expose to an extended agency function. The entire routine modifications language is mainly to target technology-driven companies, e-commerce companies, where the terms and conditions are being accepted without any much of the modifications. So those cases we have to be cautious to ascertain whether the act of the agent could lead to an exposure from an agency PE or not. Specific activity exemption. I'll still take you to article of a particular tax treaty. I'm still using India France as an example. Now if you look at Article 5, permanent establishment definition is given. Fixed place of business through which business or profession is carried on. Subpara 2 gives a list of PE. So there is an issue whether these sort of establishment will automatically become PE, or I have to carry on some business to become PE. That itself is an issue, is still long-standing. Then your Subpara 3 talks about building site or construction or installation or assembly project can constitute PE if it exceeds for a period of 6 months, more than 6 months. Then Article 4. Notwithstanding the preceding provisions of this article, the term permanent establishment shall be deemed was to include use of facilities solely for the purpose of so and so, so and so, so and so. So these are the situations A, B, C, D, E, F. Even if you do this activity, this should be shall not be, but unfortunately there is a typo in that. So if I perform this activity, then I will not be regarded as a PE, despite I am having a fixed place, because I cannot carry on a business. The reason behind why they want to give, so generally colloquially it is called as a preparatory or auxiliary activities. Why they want to give a leeway to preparatory or auxiliary activity is that it is very difficult to attribute the profit with regard to these activities. The activities are so remote from the profit generation. These are all not core activities which can lead to generation of profits. But if you look at clause F, the maintenance of fixed place of business solely for any combination of activities mentioned in subpara A to E, provided that overall activity of the fixed place of business resulting from this combination is of preparatory or auxiliary. This is one peculiar treaty where I will look at each of this activity in isolation. At the same time, I will also look at in a combined manner. In combined manner also, does it surpass the threshold of preparatory or auxiliary? If it is surpassing the threshold of preparatory or auxiliary, you will be regarded as a PE. So it's a peculiar treaty where I have an anti-abuse provisions. So imagine a situation where if a company were to structure its business in such a manner, I carve out each of this activity into a separate entity. Then I can't combine the activity of all the entities, because para 4 will apply only if I carry the activities. If the activity is carried on by someone, then it is the activity of someone else. I have a branch. The branch will only collect the information. At the same time, I am establishing another branch. That branch will have a warehouse through which it sells the products. So the information which I have collected from one branch is being passed on to the another branch, through which they identify the customers and then deliver the goods. In isolation, collection of information gets exempted under clause 4, collection of information for the enterprise. Now, delivery, if you look at it, is not being covered. So therefore, these sort of fragmentation of activities is possible between companies or between the entity itself. So therefore, I have to look at the individual activity, whether it is a preparatory or auxiliary, a combination of activities all put together, the overall resulting in preparatory or auxiliary or not. Now, another issue that comes up for a discussion is clause E. Maintenance of a fixed place of business solely for the purpose of advertising or for supply of information, for scientific research or for other activities which have a preparatory or auxiliary character for the enterprise. So therefore, if you look at clause A to D, it never uses the word preparatory or auxiliary. Only in clause C, it uses the word preparatory or auxiliary. So therefore, there are issues where what happens in a scenario where if the overseas entity is a trading company and you set up a branch in India to purchase products. Purchase of products is a core activity for a trading company. It is not a preparatory or auxiliary. But if I were to read clause D in isolation, it says for the purpose of purchase of goods or merchandise. So despite that being a core activity, still I may fall under the exemption. So therefore, questions have come up across countries. Should I look at the word preparatory or auxiliary, which is there in clause E, should equally apply to other clauses? In other words, clause A to D should also be confined to the test of preparatory or auxiliary. It cannot be a no more deemed activity exemption unless those activities fall under the ambit of preparatory or auxiliary, then only I am entitled for reduction or exemption. Otherwise, it not. So therefore, MLA gives you two choices. Option A, each of this activity that are listed in A to E will be granted exemption only if satisfy the test of preparatory or auxiliary, which means whatever the preparatory or auxiliary character which is there in clause E should equally apply clause A to D as well, either in isolation or on a combination. Individually, I have to satisfy preparatory. On a combination, if I do various activities listed here, combined basis also it should satisfy preparatory or auxiliary. Then only I am entitled for exemption. This is option A. Option B, what they say is, remain status quo, A to D clauses. If they do this activity, I don't have to test this activity for preparatory or auxiliary. It's a deemed exemption. Whereas only option E, I will test it for preparatory or auxiliary. So this is the option they have given. India has chosen option A. There are certain countries, if you look at majority of the European countries, have reserved the right of this article. They don't want to apply this because commissioner arrangement is what they have been exposed to. So therefore they don't want to accept this particular article, or they want to adopt option B, where they want to maintain a status quo. So almost majority of the cases, this article may not be applied in the Indian context. Why I am saying this is because under the domestic law, we have already amended this provisions in explanation 2 to section 9.1, business connection. They have already brought in this extended definition. So under the domestic law, you do have an extended definition, but under the treaty, you may not have. There are exceptions in some treaties where you do have this exemption. One another important aspect, peculiar, is anti-fragmentation. Now we have looked at a situation where this particular activity is carried out by the same person. Now there could be a situation where these activities could be bifurcated between entities. So I may have a branch, I will perform one function. I may have a subsidiary which will perform another function. So therefore I will look at, but they may carry on this activity from the same place or a different place. In these cases, I have fragmented a normal activity between two. So therefore, if these two activities are complementary to each other, then I can combine this activity to see the overall activity is preparatory or auxiliary or not. Despite one is done by foreign company and another is done by a associated enterprise. If these two activities are complementing each other, then I can combine. So therefore, anti-fragmentation is one specific clause which MLI tried to incorporate. India has chosen option A with anti-fragmentation. If I were to give an example, UK, they never chose option A or option B. They chose anti-fragmentation alone. So therefore, when I read India-UK treaty, I will not be bothered about extended agency definitions, rather I will be bothered only about anti-fragmentations. So this is just a gist of impact with regard to Article 30. If you look at, India has chosen option A. Australia has also chosen option A. So therefore there is a match in the notification. So therefore the extended agency function will get replaced or gets modified under the India-Australia double taxation. Whereas if you look at Canada or Cyprus, they have not chosen, they have reserved the agency function as well as preparatory or auxiliary. So therefore the extended agency function will not apply, and with regard to preparatory or auxiliary, the options also will not apply. So therefore you will remain status quo with regard to that particular treaty. With regard to France, India has chosen option A with regard to preparatory or auxiliary, whereas France chosen option B. There is a mismatch in notification. So therefore MLI cannot get replaced there. Netherlands, it is possible because they have also chosen option A, we have also chosen option A. They have also accepted the extended agency, we have also accepted extended agency. But if you look at Singapore, extended agency, they have reserved it. Whereas with regard to preparatory or auxiliary, they want to maintain a status quo. They don't want to attach the preparatory or auxiliary conditions to clause A to D. So this is how the key rule countries where the MLA positions emerge. Splitting of contracts, Article 14, this is specifically if you look at inner turnkey contracts. There already we have enough decisions from an offshore-onshore supply perspectives. Whether a contract could be split between offshore and onshore, between offshore, supply versus service separately is entered. Likewise, onshore, supply versus services are separately dissected. Whether it could lead to AOP or not, association of a person or not, there are some issues. Now, what splitting of contracts is trying to address is, see, if you dissect the contract artificially between companies, so if in France I gave we just read that a building or construction PE could emerge if the activity in India exceeds for a period 6 months and above. Now, if I were to bifurcate this activity between two companies so that I don't cross the 6-month threshold, then these are some of the anti-abusive elements that has been undertaken by the various companies. So therefore, to overcome this, they said, I will combine this activities carried on by the two entities, provided the other entity de minimis should spend 30 days in India or 30 days in a source state. If de minimis 30 days is exceeded, then this activity of two companies can be looked at together to see whether it crosses the threshold. So this will mainly apply to construction, installation, supervisory, or any provisions which or any PE provisions which deals with similar activities or a project. If there is a connected projects, there is an artificial splitting, I can combine this in essence. They are also looking at connected activities. Connected activities could be combined together if it is with the same or related persons. So therefore, the precondition is each of the constituent entity should at least present in a source state for more than 30 days. If that is satisfied, I can look at it together to see whether I am crossing the threshold or not. If one company is crossing a threshold, but another company is not crossing a threshold, then also this will be combined together to create a PE. Because they are looking at, you are artificially splitting the contract so as to avoid a PE. This is what sum and substance of Article 14. Just to give you a heads up, there is a MLI matching database that is available in the OECD website, where if you could put the selection of jurisdiction, it will give you this picture. It's a concise form with regard to which of the article will apply to us, which will not apply to India. In effect, this is just regard to the other articles of MLI with regard to how does it work. This will give you an overall impact with regard to a select jurisdiction. I have taken Australia, Canada, Cyprus, France, Netherlands, Singapore, and UK. And I have given a brief of key articles, not of, if not all the articles, just the key articles in summary with regard to how the MLI works.